Hello everyone and welcome back. How are you all doing? I hope everything is going great. So our today's video is going to get you approximately around 10 marks in your examination. Yes, that crucial is today's video. So we know the current weightage for November 23 examinations for IDT is 75 marks GST and 25 marks customs plus FTP. If you are appearing for May 24 examinations, then your weightage would be 80-20. Now, in this 75-25 or 80-20, every attempt, if we go by trend analysis, every attempt has 5 marks question of valuation under customs. Like we study ITC, input tax credit in GST, considering that this chapter is definitely going to come. Same thing applies here. This valuation under customs is definitely going to come. So out of this 25 marks weightage, also if we know that a 5 mark question, now this is a 5 mark numerical question. You might even find 1 or 2 mark MCQ also or some other question also. So this weightage can go to 5 to 8 marks also. So if you understand, it is approximately 20%. 20% like 5 upon 25, 20% of your total weightage. So the chapter is extremely important. So we are going to study entire theory of this chapter and then try solving the questions also. Now, one thing that you need to understand is no matter how many times you go through the theory of the valuation chapter, ultimately the required confidence you are going to get from question practice only. Even one day before examination, I would be recommending you to just quickly in 10 minutes go through the theory, whatever you have marked, and then focus on question answer only, because there's a pool of questions being fixed in this particular chapter. The act is from 1962, right? So, and there are no major amendments anytime. So ICAI has tried and tested everything that they wanted to. Now there's a pool of questions being set. Some or the other adjustment is tweaked from 1 or 2 questions and a new question in examination is being made. So if you practice all of the questions of the question bank, I would tell you this with very much confidence that something related to that is only going to appear in examination. So make sure you practice as many questions as you can for this particular chapter, right? The video is going to be in English. Yes, the video is going to be in 100% English because Hindi valuation revision as well as question answers I have already uploaded in the Hindi playlist of the channel. You can just go through the November 23 revision Hindi videos. You will be finding revision for valuation as well as the question answers video. So this video is specifically for South Indian students in 100% English only. So let's start. Let's start with valuation under the Customs Act. Yes, good morning everyone and thank you Ishwar. All the best for your future. Sure. So starting with valuation under the Customs Act, first of all, before beginning, let's just understand some of the general terms which would appear in questions a lot of times or even in MCQ you may see. So starting with X factory price. Starting with X factory price. What do we mean by X factory price? Simply, if your contract says that the buyer is going to come to factory, and collect the goods from there. So whatever is your production cost plus profit, cost plus profit is what you are going to charge from your buyer. This is known as X factory price. But let's say our contract says we are going to collect the goods at the port of exporter. Now see, understand. This is port of exportation. This is port of exportation and this is port of importation. So the exporter manufactured the goods here, added profit, and this is known as X factory price. Now the goods are brought from factory. The goods are brought from factory to the port of exportation. The goods are brought from factory to the port of exportation. So whatever expenses you would be incurring, say for example, for bringing goods from here to here, I would be incurring some kind of freight, loading charges, or some local freight, port charge, C&F agent charges, which simply means my goods are ready. My goods are ready to be loaded on ship. So here my goods are ready to be loaded on ship. Now only those charges are left, which would be loading charges to load the goods on the ship. Other than that, all of the local charges I've already incurred. This price is known as free alongside ship. So X factory price plus loading to transport the goods from exporter's factory till the port of exportation, plus any local freight being incurred, C&F agent charges or any of the port charges. You add all of this and you get free alongside ship. So say for example, I make a contract with you that I will be selling you goods on free alongside ship, which simply means that I would deliver the goods at my port of exportation near the ship. Now after this, all of the risk will be passed on to the buyer, and all of the further expenses, the expenses of loading the goods on the ship, taking the ship from here to port of importation, all of this will now be incurred by the buyer meets the importer. Now talking about free on board. Now this is the price which would be extremely important for us to solve the question answers. Free on board means, say for example, we have a contract where I tell you that I will be supplying you goods free on board, which means once me as a seller loads all of the goods on the ship, my responsibility is over. Now if something happens during the transit, the responsibility will be on you, means the buyer. So your seller is responsible for loading the goods on the ship. Post loading, the risk would be transferred to buyer. So free alongside ship plus I add the loading charges, or plus for if these particular goods any export duty is required to be paid, then I also add this export duty. So this would give me free on board value. Now the goods, the ship. The ship started from the port of exportation. Chalte chalte, it came here. It came to the port of importation. Now here we call it as CIF value, which is normally the assessable value under customs. So when we are going to solve the numericals, they'll be giving you basic customs duty at 10%, 20% or whatever duty being levied. That duty is always levied on this CIF value, which is cost, insurance and freight, the value which we call as assessable value. Means here the goods have reached the port of importation. So to the FOB value, I add the insurance and the freight which was incurred during the transit, and here I get my CIF value. So let's say our contract says that I will be supplying you goods at CIF value, means being a seller, I will be responsible till the goods reach the port of importation. But if our contract says that the goods are to be supplied FOB, means my responsibility would get over once I load the goods in the ship. So in case of a CIF contract, the seller is responsible till the place of importation, and post that unloading and everything is done by the buyer. So once the ship reaches here, import is done, my responsibility is over. Now any of the port dues, import duty, unloading charges which you incur at this particular port of importation, at none of the time exporter would be liable for this. So even if our contract is on CIF basis, means the responsibility of the seller would be over once the goods reaches the port of importation. Now post that any of the port dues, import duty, unloading charges, means whatever is incurred locally here at the port of importation, that would not be relevant for CIF value. And then from port, I ultimately take the goods to my factory, clear the goods for my home consumption. All the import duties and everything will obviously be paid by importer, and exporter will have no responsibility in this particular thing. So see, the terms are explained separately. You do not mix. Students ask me this doubt that ma'am, here you have written that the risk transferred to buyer after the goods are loaded. Here you have written that the risk is passed on once the goods have reached the port. Understand, it is not on a continuous basis. To explain you, I have given this kind of a chart so that you exactly understand at what point what price is given. But all of these terms are independent terms. Means if our contract says that we are doing FAS contract, free alongside ship contract, means here only the risk and liabilities would be passed on once I bring the goods to the port alongside the ship. Or if our contract says that the goods are to be supplied on FOB value, which means the responsibility of seller would continue till the goods are loaded on the ship, and post that the responsibility would cease. Say for example, our contract says that the goods are to be supplied CIF, means the seller's responsibility would continue till here. So all of these terms are independent terms. To explain you the meaning, And to give connectivity to you, I have made this kind of diagram so that you exactly understand the meaning of every single term. Right. Now, related person under customs. If you are my student, you would be remembering related person under GST. Quickly, chalo. In the comment section, tell me who are the related person under GST. Everyone. Quickly tell me related person under GST. Yes, it is Sofa Corps. So related person under GST was Sofa Corps. Sole agent, family, control, officer in one another's business, partner, employer, employee, and shares. So this is what we had studied under GST. Customs is also somewhat similar with one or two variations. So here, officer or director of one another's business, we know. Legally recognized partners, yes. Employer, employee, yes. Now this is crucial. Any person directly or indirectly owning, controlling or holding 5% or more of the outstanding voting shares in both of them. See, understand what this 5% signifies here. What this 5% signifies here, they are not saying that if A is holding 5% or more in B, if A is holding 5% or more in B, they are related. No, this is not what they are saying. They are saying if a common person is holding more than 5% in two people, means A is holding, let's say 7% in B, A is holding 10% in C. In this case, government is saying that B and C will be considered as relative. They have nowhere mentioned that you owning more than 5% in a particular company and you both become related person. The answer is no. They are saying if A is controlling B, A is controlling C, in that case B and C will be related person. A is owning more than 5% in B, A is owning more than 5% in C. In that case, B and C will become related person. So here, any person directly or indirectly owns, controls or holds 5% or more of the outstanding voting shares of both of them. Most important is both of them. So directly holding more than 5% will not make you a related person here. Mark this as extremely important. In GST, we know if you directly hold 25% or more, you directly become related. This is not the case in customs. For customs to you be directly related, you need to directly or indirectly control the other. Now we understand to control, we need to at least hold greater than 50% of the shares. So they have not given any direct shareholding criteria here. Means if A has to be become a relative of B, means there has to be a relationship of control. Now, a relationship of control means greater than 50% shares being held. So, they are not saying directly to hold 5% of the share. They are saying if one person holds more than 5% in two other people, those two other people will become related person. But for A and B to become related person, there has to be control, which implies that the shareholding has to be greater than 50%. Right. Then they are saying both of them are directly or indirectly controlled by a third person, right? Understand? See, B and C, both of them, if controlled by A, in that case B and C will become related person, or one of them directly or indirectly controls the other, means A is directly controlling B, then A and B would be considered as related person. Together they directly or indirectly control a third person, means A and B together control C. A and B together control C, then also these people will become related. In all of the cases, you need to remember a triangle structure. And last, if you are members of same family, in that case, you will be considered as related person. So this was about the definition of related person under customs. Somewhat similar to GST, means the officer, the employee, the director's part, everything is same only, control and everything. Just remember the difference in the shareholding that they have given under customs and under GST. Right. Just give me 1 second. I forgot to put mic. The quality of audio would not be clear to you. 1 second. Okay, yes. Now let's start with assessable value, the term for which we are studying the entire chapter, which is assessable value. Why? Because we understand that the rate of duty we are going to apply on the assessable value. So like in GST we study value of supply. Under customs we need to determine the assessable value, on which value GST is going to be levied. Right. Now there can be two things: transaction value under section 14.1 or tariff value under section 14.2. Tariff value is very much simple. So for certain notified goods, there are certain notified goods like gold, silver, etc., where you can do transaction on whatever price you wish to do. Government has a fixed tariff value that we are going to levy. We are going to levy the import duty on this particular value only. So say for example, if you import 10 grams of gold, you actually would be doing this transaction on any particular price. We are least concerned about this. Government has fixed a rate. That for every single gram, this is the tariff value on which you are going to pay GST. So here no rules, nothing would be applicable. Simply duty shall be chargeable with respect to whatever tariff value government has already fixed. Your original transaction value would be irrelevant at all of the places. Right. But if we talk about transaction value, means your goods are not one of those notified goods for which government has fixed a tariff value. In that case, what you are going to do, price actually paid or payable when sold it for export to India, means the actual transaction price between exporter and importer, delivery at the time and place of importation, buyer and seller not related, and price is the sole consideration. Kuch yaad aa raha hai? Can you remember of something? This is what we had studied in GST also. Transaction value means price actually paid payable, buyer seller not related, price is the sole consideration. Now because this is a case of import export, they've added this delivery at the time and place of importation. So price which is paid when? Price which is paid at the time of importation. Now say for example, we had agreed that this particular consignment will be sold for $1,000. But at the time of contract, we decided that this particular consignment will be sold for $1,000. But later, before importation only, we renegotiated our contract and we decided that okay, this will be sold for $950. Now at the time and place of importation, the contract value was $950. We actually paid $950 only. Now in this case, the assessable value would be this $950, which is the renegotiated value. And therefore they've included this one extra point also, that it might be possible that before importation, you've done a lot of renegotiations, but ultimately, whatever is the price which is paid or payable at the time and place of importation, that value is going to be your transaction value. Buyer seller are not to be related and price has to be the sole consideration. Done. Now starting with rule number 3, which talks about determination of method of valuation. How to determine the value of imports. So see, if your transaction value is rejected under rule 12, means whatever your actual transaction value you are saying, the price at which you are doing the transaction, if officer is rejecting it, means you are saying that we are importing for $1,000, but officer is saying no, this price doesn't seem right to me, it has to be $1,500. You are trying to save your duty. So in this case, either officer is rejecting your transaction value or transaction value is not available only. If any of such cases there where the officer is not accepting your transaction value, or let's say there's no transaction value, there's no price or anything involved, in this case you are going to determine your value by applying rule 4 to 9 sequentially. Now what do we mean by sequentially? You have to go chronologically only. Means if you are unable to apply rule 3, you will apply rule 4. Unable to apply rule 4, then only you are going to go to rule 5. You cannot directly jump to rule 5 from rule number 3. So simply they are saying, if your transaction value is rejected or there is no transaction value available, now in this case you are going to use rule 4 to 9, but make sure to use those rules sequentially. You cannot directly jump to rule 5 or rule 8 or rule 9 from rule number 3. You have to go sequentially. ए भाई समझो chronology follow करना है. Right, but this is not the case, means the transaction value is available and accepted. Simply apply rule 3, then whatever is your original transaction value, we are going to accept that only as your import value, and plus whatever adjustments of rule 10 are required to be made, you please make sure you have done those adjustments. Very much simple. Right. So normally your transaction value will be accepted only. Normally your transaction value will be accepted only provided that there are no restrictions as to disposition or use of goods by the buyer. So say for example, when the exporter is sending certain goods to importer in India, he is not putting any restriction on disposition, means he is not saying that whenever you dispose you are required to do this, or these are the conditions, you can use the goods only in this particular ways. If there are certain restrictions being imposed, then transaction value might not be accepted. There has to be no restrictions. Once I have imported, then it is on me what I want to do with those goods. But if there are these 3 kinds of restrictions, it is still okay. Say for example, if there is a restriction imposed by law or public authority, you cannot do anything. If law or public authority is imposing any restriction, that is fine. In that case, we will not reject your transaction value. Or if there is a limitation with respect to geographical area, what do you mean by this? Say for example, Suzuki. Suzuki is a Japanese company, right? Selling 2-wheelers in India. Now in this particular case, they have their dealers appointed in India. So say for example, you are a dealer of West Zone in India, or you are a dealer of South Zone in India. And Suzuki is exporting goods to West Zone dealer also, South Zone dealer also. In this particular case, obviously Suzuki would be importing geographical restrictions, that the dealer of South Zone would be selling those imported vehicles in South only. The dealer of West Zone would be selling those imported vehicles in West only. Why? So that there is no conflict of interest arising. This is a very much normal practice. So that they do not break each other's market. So the exporter can put certain geographical restrictions. Because I have dealer in some other area, I do not want you to enter there, because that dealer will be affected. So in this particular case, if the restriction is put by law, or there is some geographical area limitation, or some small kind of limitation which is not affecting our value, in that particular case, if there is restriction, then also it is fine. But otherwise than that, there has to be no other restrictions as to any use or disposition of the goods. Otherwise, we will not be accepting transaction value. Then, price or sale is not subject to some condition consideration for which value cannot be determined. Means you are putting some kind of condition. For which we cannot determine the value only. In that particular case also, we are not going to accept your transaction value. See, B and C point you can study together. No subsequent sale proceeds accrue for which no adjustment can be made. Understand, today when you imported goods, you imported the goods for 150 rupees per unit, right? You imported the goods for 150 rupees per unit. This is the transaction value that you paid to your seller. But you both agreed on a contract saying that for every unit sold in India, you are going to pay him 100 rupees more. So currently your transaction value, your import value is 150, but you both have entered into a contract saying that on every subsequent future sale, you are going to pay 10 rupees, 100 rupees more. Do you understand? You're trying to fool government saying that the import value is 150. No, ideally the import value is 250. It's just that 150 you are paying now and 100 you are paying on later. So here we understand this is the exact 100 definite amount which is going to accrue. So today only when you import, we will be considering 250 as your import value and not 150. But say for example, you enter into some weird kind of contract where we are not able to determine this 100 only. You keep things open, that at that particular time, whatever will be sale, we'll take this percentage of this or anything like that. You enter into some open contract where this 100 is not determinable only, but there is certain condition or restriction arising which is going to be affected later on. In that particular case, we will not accept your transaction value. See, if adjustment is possible, if direct, simple, plain adjustment is possible, we are going to make that adjustment. If adjustment is not possible, or let's say the value is not determinable that what you are going to do in this future condition or consideration, in that case, we will not accept your transaction value only. And the officer is going to determine the value as per his rules. right? And then buyer and seller are unrelated. We obviously understood this, that the buyer and seller has to be unrelated for us to accept the transaction value. If they are related, we will not accept the transaction value. But there's an exception saying that if the relationship did not influence the price, we are related. See, we are related, we are members of same family, but that does not influence our value at all. Means our relationship is not influencing the commercial transaction that we are entering into. Also, whatever value we are telling, whatever transaction value we are telling, it closely approximates if you use rule 4 to 8. See, you are saying that we will not accept your transaction value under rule 3 if you are a related person. I tell you, okay, do not accept. Means you are going to start apply rule 4, 5, 6, 7, 8. Now, even after applying those particular rules, you arrive at that value only, which I am telling under rule 3 or somewhere close to that. In that particular case, government is saying it is okay. We will accept the transaction value only because your relationship is not influencing the price. And also, if government starts applying rule 4 to 8, it will result in a value which is somewhere close to whatever value you are telling under rule 3. So normally the transaction value is not accepted if you are related person. But if your relationship is not influencing the price or your value closely approximates rule 4 to 8, in that particular case, we will accept your transaction value even if you are related person. Right. So I told you that if all of these conditions are satisfied, you can apply rule 3 and determine your transaction value. But there are certain adjustments. There are certain adjustments that you are required to do under rule 10. Now, what are these particular adjustments? Let's understand. So, your assessable value would be your transaction value plus the rule 10 adjustments. Now, rule 10 adjustments have two sub-rules. Adjustment under 10.1 and adjustment under 10.2. This is a chit page. This is a chit page, means whatever question is going to come in examination, 99.9% it is going to come from this particular format or table that I have given you here. So make sure you remember this format word to word, and if not able to remember, just tear this page, fold it and take it along with you in the examination. But it is non-negotiable. You have to know this particular format, and you will get hold of it once you practice 5, 6, 10 questions. You will automatically remember it. So no matter how many times you read it, you will not be able to remember unless you solve the questions. So as we complete the revision, we are going to solve questions and it will be 100% clear to you. See, understand. So always, first of all, mark this point to start your answer with FOB value. The question might give you X factory price, free alongside price, CIF value. You make sure to always come at the FOB price. Now I have already taught you that what to add in X factory price so that you come to FAS. What to add in FAS so that you come to FOB. If they have directly given you CIF, you make back calculation and come to FOB. But make sure to always start your answer with FOB value only. Now there would be certain cases where they have directly given you CIF value and the question is extremely simple. No adjustment is required to be made. In that case, we might go directly to CIF, but otherwise, in all of the answers, you are going to start your answer with free onboard FOB value only. Now 5 adjustments with respect to rule 10.1, saying that any of the commission, even if it is local commission, exporters commission, whatever commission it is, you are going to add this commission in the FOB value. But remember, never you are going to add buying commission. Now they can give you buying commission from India also, buying commission outside India also, anywhere if there is a buying commission. If there is any commission in the name of buying commission given in the question, you are not going to add that buying commission to come to your CIF value. Other than that, if there is a commission in any of the name, say channelizing agent commission, local commission, exporters commission, any XYZ commission, always you are going to add this particular commission. Any packing charges separately being mentioned, any container charges separately being mentioned, every time you are going to add this. But if the containers are durable, returnable, then you are not going to add here, because we understand that for durable containers, we assess them separately only. Right. Then any of the assistance by importer to the supplier. See, this is similar to what we study in GST. That if you as a supplier supply anything free of cost to the buyer, in you as a buyer supply anything free of cost to your supplier, now in that case supplier's price would reduce. Like say for example, there is a certain goods which you are going to sell me for 100 rupees, but to manufacture these goods you need a machinery. Now if you purchase this machine on your own and sell this to me, so we have agreed on the price of 100, but I tell you I already have machine, I have a spare machine with me, you do not purchase this particular machine, I will give this machine free of cost to you, but you give me the goods at 75 rupees only. So here the transaction value would be 75. But do you understand why it has become 75? Because there is something that the buyer is supplying free of cost to seller, for which the seller is agreed at a 75 price, otherwise the price should have been 100 only. So they are saying that if any of the material, component, part, item, anything, if you have given to your seller at free or at reduced cost, make sure to add that amount back to come to the original price. So any tools, dies, molds, anything, any engineering development, artwork, plans, sketches, whatever you as a buyer have supplied to your supplier, you as an importer have supplied to your exporter, make sure to add it back in the FOB value. Here again one more important thing, if they have given you any of the engineering, development, artwork or plan or any of these charges, make sure that these things, engineering, development, artwork, has to be undertaken elsewhere than India. Say for example, they are saying engineering charges incurred in Japan, add it. They are saying engineering charging incurred in USA, add it. Engineering charges incurred in India, you are not going to add it. So any of the engineering, development, artwork, plans, sketches, designing charges which are incurred in India only, that you are not going to add. Now as I said, I can explain you theory 10 times, it will not go in your brain unless we solve one question. One question we are going to solve and all of these things will be clear to you. But for now, keep all of these things in your mind, that you are not going to add buying commission, you are not going to add any of the engineering charges which are elsewhere, which are in India. Means if it is undertaken elsewhere in India, then you are going to add it, right? Then any of the royalties or license fees that related to imported goods but paid by buyer, means ultimately the obligation of supplier. Supplier was related to supplier was actually liable to pay any of the royalty or license fees, but buyer is paying on behalf of supplier. We are going to add it to the value. Any of the subsequent sale proceeds, as I explained to you with the example of 150 and 100, means this is a subsequent sale proceed. Currently we are importing for 150, but subsequently we are going to give you 100 also out of the sale proceeds. So this also we are going to include. But if there is certain dividend, do not include that dividend. And any other payment, all or any other payment made as a condition of sale to seller or third party on seller's obligation, means later any of the amount that you are required to pay to seller or on directions of seller you are paying it to some another third person, then also you are going to include everything in this FOB value. Now after making these adjustments in FOB value, we arrive at a value which we call as adjusted FOB. So after making adjustments, see, understand why I told you to always start the question with FOB value, because the question would sometimes make certain adjustments and give you a value. Sometimes they would directly give you CIF value. Nothing would be relevant to us. We will go to plain FOB value, make adjustments as per our understanding and arrive at the adjusted FOB value. So this was all about rule 10.1. Now rule 10.2. Rule 10.2 only has two adjustments, one with respect to freight and one with respect to insurance. Only and only two adjustments, one with respect to freight and one with respect to insurance. Okay. So freight means any of the cost of transportation, loading, unloading, handling charges associated with delivery of the goods to the place of importation. Means once you reach the port of importation, now any of the unloading charges incurred on port will not be considered because import is being done. Once the goods reach India, import is completed, import is done. Now post that, whatever charges you are incurring, that will never be included. But any of the transport, loading, unloading, handling, any of the charges which are related to the delivery, can I call it as freight in one word? Yes, this I am going to include. Now understand. If the question says you are importing from vessel, means you are importing from ship. In that particular case, if they are giving you original freight, if they are giving you the original freight amount, take that. If they are giving you original freight amount, take that. Certain questions, they will not be giving you freight amount only. Means they've given you FOB value, every other data. They have not given you freight amount. Now, is it possible to import goods without freight amount? The answer is no. So if the question is not giving you freight amount, you have to take 20% of adjusted FOB. So whatever you have arrived here, the adjusted FOB amount, compulsory freight always you will have to consider for the calculation of CIF value. If the question gives you original freight amount, then take that original freight amount without thinking anything. If the question is not giving you original freight amount, in that case 20% of this adjusted FOB you are going to take as your freight expense. But if you are importing via air, in that particular case you are going to compare original and 20%, and whichever is lower is what you are going to take as the amount of freight. What is the difference here? Understand. For vessel, if they have given me original, I will not think of 20% only. I will take original freight and that will be my final freight. If they have not given me original freight in case of vessel, then I am going to add 20% of adjusted FOB. But in case of air, even if they give me the original freight, I am going to compare it with 20% of adjusted FOB, and whichever is lower is going to be my final freight in case of air. So if there is the mode of importation, any other mode other than air, what you do, if actual available, take actual not available, take 20% of adjusted FOB. But only and only in case of air, you are always going to compare actual with 20% of adjusted FOB, and whichever is lower is going to be your final freight. Quickly tell me you all understood this point and it is completely clear to us. Freight 100% every time we are going to add. Even if the question gives freight amount or does not give freight amount, we have to add the amount of freight. Now if they've given the original amount, take that. If not given original, take 20% of FOB. But in case of air, you will always compare. See, if they do not give original, you are left with no option but to take 20%. But even if they have given original, then also you will take 20% of adjusted FOB, compare both of them, and whichever is lower is going to be your freight amount. Quickly in the comment section, tell me everyone, this point is extremely clear to you, because none of the exam question would ever come which does not include this particular adjustment. Every single exam question would 100% have this freight adjustment given in the question. Right. Now do not add. See, once the goods have reached port of importation, do not add port dues, landing charges, any other expense which is incurred at the port of importation. But you are going to add ship demurrage charges, barge charges, lighterage charges only if, see, this only if point you will understand once I solve a question. You are going to understand this only if point. So for now you can leave this. Other than that, ship demurrage charges, barge charge, lighterage charges. Now what is this? Do you remember we had studied? This is the port of importation. The vessel is extremely big and we do not have a dock which can berth this big vessel. So what we do? We use small boats. Called as barges, and we unload the goods here and then bring the goods to the port of importation. So would these charges be included? The answer is yes. Because the mother vessel waits at a distance from the port and we are going to include all charges incurred till port. So whatever charges we incur for these small boats, barge charges, lighterage charges, any ship demurrage charges, all of these charges are going to be included. See, if you are taking actual, now this all is possible only in case of vessel, right? If it would never happen that the aircraft is waiting in air and you send some small aircraft to unload goods and then bring here. So these barge and lighterage charges in case of air is not possible only. We understand this. It is possible only and only in case of ship. Now even if the question gives you air demurrage charges, you ignore it. Only ship demurrage charges, barge or lighterage charges would always be included. Right. So if it is a case of vessel, now explaining you this 20% point, right? If it is a case of vessel and they are giving you all of the original barge, lighterage and freight charges, you add everything. You add everything and take this original amount as your freight amount. But when you add all of this and compare it with 20%, compare it with 20% of FOB. Now, first of all, understand, there is no comparison in case of vessel. Comparison always will be required to be done in the case of air. No comparison in case of vessel. Now, what they do in questions sometimes, understand. They will give you X factory price. They will give you X factory price. They will also give you ship demurrage charges. They will give you ship demurrage charges. They would also give you certain loading charges which are being incurred from the port of exportation till the from the exporter's factory till the port of exportation. Means they have given you some other small charges. They have given you these loading charges. They have given you ship demurrage charges, but they have not given you actual freight. They have not given you the actual freight that you incur from the exporter's port till the importer's port. Now, in this particular case, we understand. In case of vessel, when I do not have original freight available with me, I take 20% of adjusted FOB. I take 20% of adjusted FOB as my freight. So, this particular point is saying that if in question they have given you ship demurrage charges, but they have not given you the original freight, hence you take 20% of adjusted FOB as your freight. If this is the case, then we will be deemed assuming that this ship demurrage charges is included in this 20%. I am repeating once again. See, the question tells me 100 is the X factory price. The question tells me 100 is, let's say, FOB price. 100 is FOB price. They have not given me freight amount. They say 10 is ship demurrage charge. 10 is ship demurrage charge. Now, in this case, since I do not have original freight available with me, what freight I am going to take? 100 is the FOB. Let's assume this is only the adjusted FOB. I will take 20% of 100 as my freight. 20% of 100 as my freight, which comes to 20. Now, I am not going to add this 10 again. Do not add this 10 again. Now, we will assume that this 20 includes 10 already. But if the question says 5 is the freight amount, plus let's say there is some 6 rupees other unloading kind of charges, and 10 is the ship demurrage charges. Now all of the original amounts are given. Then I add all of them separately and arrive at my final freight amount. So if original freight amount is given, then you add ship demurrage in it. They do not give you original freight amount and they only give you ship demurrage charges. Then you take 20% of FOB and assume that all of these demurrage charges are already included in this 20%. Understood? Say yes or no. The only catch in entire chapter is here. If you are done here, you can virtually say your chapter is over. Now remaining part there is nothing except for this table. Other than that, entire chapter is not that relevant for examination purpose. Only these two adjustments that I taught you now for freight are extremely important for exam point of view. You can just give it 5, 7, 10 stars, whatever you want. Right. Now talking about, still if you have little bit of query left, it is okay. Once we solve question answer, you will be 100% clear. Now, cost of insurance. Again, if they have given you actual insurance. Now here you need not compare anything. The comparison in case of air is only for freight. Insurance is very much simple. Whatever be the mode of importation, it is irrelevant. Always, if they have given you actual freight, actual insurance, take actual insurance. If they have not given you actual insurance, then 1.125% of adjusted FOB you have to take. If they give you actual freight, you take that. If they do not give you, you take 20% of adjusted FOB. Insurance also compulsory, you will always have to include. If they give you original insurance amount, take that. If original insurance amount not given, take 1.125% of the adjusted FOB. And once you add everything, you arrive at the assessable value, which is also known as CIF value. And the duty is levied on this CIF value. See, we have studied types of duty chapter, right? In types of duty chapter, they give you CIF value in the question. And then they give you multiple types of duties. and you need to determine what would be the amount of duty. Valuation is a pre-chapter to types of duty because valuation teaches you how to come at this CIF value. Now, once you arrive at CIF value, the job of valuation chapter is done. From here, the job of types of duty chapter starts, which tells you that if there's a safeguard duty, anti-dumping duty, basic custom duty, social welfare surcharge, the duty to be levied on what particular amount, that is a job done by types of duty chapter. So once you determine the CIF value, the valuation chapter gets over here only. Done. Chalo. Now we understand. But if the value is not determined under rule 3, then we sequentially apply. Rule 4 to rule 9. Now there is nothing very much particular about rule 4 to rule 9. 10 minutes and the entire chapter is over. Rule 4 simply says that if your goods are not having any proper transaction value, you take transaction value of identical goods. What do you mean by identical goods? So the goods imported, some other person has imported some other goods. So the imported goods same in all respect except minor differences produced in the same country. So say for example, US to India, certain importation is done. I am unable to determine my transaction value. This same country US exports identical goods only. There might be small differences, but kind of identical goods only to India, to some another person, say for example. In that case, I will be taking the value of identical goods to determine my transaction value, and if there are any minor differences, I will make adjustment with respect to that. So imported goods are same in all respect, might be except minor differences, produced in same country. The idea is the goods are produced in same country. Now you cannot take any third country, because understand, now this is import export. The distances of countries would differ. Today if I want to import something from Pakistan, not possible what Pakistan is going to export us, but still today if we are importing something from Pakistan, we understand that the freight expense is negligible. This is Pakistan, this is India. But if I import goods from some another country which is at more distance, there would be more other expenses. Also, the economies of the countries are different. The cost of production would be different. So you cannot take any country. Say for example, I import a mobile. I import one mobile from USA and I import one mobile from Japan. I cannot take the identical value of Japanese mobile for USA because the economies are different. Their cost of production would be different. Distances from the countries would be different. So the goods, for them to be identical, are required to be produced in those same country only. And you do not include any of the goods. For which the design or engineering work is undertaken by buyer in India and are provided to seller at free or reduced cost. So me being a buyer in India is incurring any of the design engineering charges and then sending it to free or reduced cost to supplier, then supplier sending those goods. In all of these cases, you do not take the identical goods value. Okay. But very much important, the value of identical goods imported in India has to be at about same time of importation. Say for example, 2023. I am in August 2023. So the goods imported in, let's say, August or July or June would be relevant goods. I cannot take some goods which were imported in 2015, saying that see, identical goods imported in 2015, take this value. Inflation and a lot of things would have affected from then till now. So you have to consider the goods. You have to consider the identical goods which are somewhere near or at the time, at or about the same time of importation of these goods only. Second, has to be same commercial level. Means today if I import 1000 units of calculation, a calculator, I would be getting that at a cheaper rate. Comparatively, if I import 100 units of calculator or let's say 50 units of calculator, this would be costly and this would be comparatively more economical. So they are saying that you do not take any value. Like one person is importing one good, another is importing 1000 units of those particular goods. Obviously, the value of 1000 units would be lesser considering the quantity discount. So in that case, you also take the identical goods at the same commercial level and quantity. If not available, then make sure to make that quantity discount adjustment. Okay. Now say for example, I am importing 500 units. Now there are 10 options available with me. One person has imported this identical goods only. 10 units. One has imported 100 units. One has imported 200 units. One has imported 480 units. Another 500 units. Then let's say 530 units, 700 units, 1000 units. This is what. So at or about same commercial level also, I have more than one or two options available with me. Right. So 480, 500, 530, 700 is near 500 only. So I have more than one option available with me. Now what to do? Now they are saying if at same or commercial level also you have more than one option available, you take lowest of all options. This is a benefit given to you because lower the value, lower will be the import duty. So they are saying that if at same commercial level you identify more than one transaction value, it is okay, you use lowest of the all. And then if there are any significant differences in freight insurance, make sure to make adjustment of freight and insurance as per rule 10.2. So this was about rule number 4, saying that if you are unable to apply rule 3, apply rule 4, means take the transaction value of identical goods, but keep these points in mind. Now, unable to apply rule 4, you come to rule 5, saying transaction value of similar goods. Now see, similar goods would not be alike in all respects. So your first preference would always be going for identical goods. But if the identical goods are also not available, then you can see that, okay, there are some major differences also, but we can make adjustments. So the goods are produced in same country. This condition always remains. I explained you the logic why. The goods are produced in same country, but they are not alike in all respect. The characteristics, the components or the raw materials used are kind of similar. So the value would also be kind of similar. So they have like characteristics, like components, material, enabling them to perform the same kind of function. In that case, we can use the value of these similar goods again. This will not include any of the goods with respect to which engineering or anything is undertaken in India. Also, again, this same point that it has to be at the same time commercial level has to be similar. If more than one quantity which is similar only at same commercial level, you take lowest of all of these points. Remaining clauses, all of this mutatis mutandis applies as we studied in rule 4. See, as I said, whatever was there was rule 3 and rule 10 only. After that, rule 4, 5, 6, 7, 8 are negligible chances that these questions even appear in exam. So majority of the times, 95% of the times, the question is from rule 3 and rule 10 only. This we are studying because given in module, but rarest of the rare chances, I would say like in 6, 7, 8 attempts, sometimes they would be asking question from this rule 4 to 9. Otherwise, question is always from rule 3 and adjustments of rule 10 that you are required to make. Done. Now rule 6 is a must rule. Rule 6 says that normally you have to apply chronological sequence, right? As I told you, first of all, rule 3, if not able to apply rule 4, if not able to apply rule 5, if not able to apply 6 and so on. Now rule 6 says that normally you apply rule 7 and then rule 8. But in certain cases, if you make a request to proper officer, proper officer can allow you to apply rule 8 before rule 7. That is it. Rule 6 is just an empowering section. Rule 6 is just an empowering rule saying that if value cannot be determined using rule 3, 4 or 5, you normally apply rule 7 and then rule 8. But at importer's request, if importer requests to proper officer, in this particular case, proper officer may allow using your rule 8 before applying rule 7. So normally you go by the chronology, but rule 6 is giving you this power. Rule 6 is giving you this power to proper officer, that if the importer makes a specific request saying that I want to apply rule 8 before rule 7, it is in proper officer's hand. Proper officer can allow you to break the chronology and apply rule 8 before rule 7. Alright, now let's come to rule 7. Let's consider that importer has not made any request only. So we go from rule 3 to rule 4 for identical goods, then rule 5 for similar goods. Now rule 6 will become not relevant for us. Then we come to rule number 7, which talks about deductive value. Means whatever I have imported, transaction value is not acceptable. There are no identical or similar goods also available. Then what I am required to do? I will back calculate. Means deductible value, saying that whatever I have imported, ultimately I am going to sell those goods in India. So what is my resale unit price in greatest aggregate quantity to unrelated person? Say for example, I imported 1000 units from USA. Of this, I sold 600 units to Mr. A, 50 to Mr. B, 100 to Mr. C, and remaining I was selling in retail 1 to 10 goods, whatever the customer's demand was. Now in this particular case, what is the greatest quantity in which I have sold the goods? 300. What is the price at which I have sold these goods? So resale unit price at in the greatest aggregate quantity to unrelated person. This is my resale price. Means there would be some expenses that I would have incurred after importation. Means once you import goods, you add your profit to it, any commission, any general expense within India, if any transportation is required to be made, customs duty that you pay related to import. So if I reduced all of these costs, from my resale price, I will automatically arrive at my import price, which is the CIF value. So they are saying you do not hold your like this, you do it like this. You do it like this means what is your resale price in India? What is your resale price in India? From that you reduce your profit, you reduce any local Indian transport charges, you reduce any commission that you pay in India, you reduce any general expenses that you incur in India, you reduce any import duties that you have paid. Means by deducting these values from my resale price, I will automatically arrive at what is my CIF value under customs. Also, if there is no resale price available at or about the time of importation, means I've imported the goods but I have not sold any of these goods at this particular point of time, they are saying it is okay, unit price at earliest date possible after import. We can wait after import also, and whatever is the earliest date after import when you are selling these goods, at that point of time we will consider that resale value, but make sure it has to be before expiry of 90 days. So once you import, within 90 days do whatever you want to do, bring a resale value, make this back calculation and arrive at the deductive value. Say yes or no everyone. Say yes or no everyone, awake, alive and attentive in the class. You are understanding what we are studying. Quickly give me a thumbs up. So if everything is okay, we take the value as per rule 3. We do not take the plain value of rule 3. We make whatever adjustments under 10.1 and 10.2 are required to be done. This is what happens normally. If unable to apply this, we will come to rule 4, which talks about identical goods. Unable to apply this, we come to rule 5, which talks about similar goods. Unable to apply this, we normally come to rule 7 and then rule 8. But there is this rule 6 in between. Saying that if importer makes request application to proper officer, officer has the power to allow you to use rule 8 before rule 7. Otherwise, generally rule 7 will be applied after rule 5. Yes, hashtag Dil Dil Agag Bomb Bomb in the class. Done. So we've studied rule 7. Now let's get to rule number 8. Rule number 8 says take computed value. Means think from the point of exporter. So if goods are being imported into India from USA. So who is my exporter in USA? What costs he would have incurred to manufacture this particular calculator? I import this calculator from USA. I understand plastic is being used, buttons are being used, cell is being used, all of these things are being used. So what is the cost of material, fabrication, other processes? What profit that person would have kept on this particular calculator? What general expenses he or she would have incurred? Then as per 10.2, what would be cost of transportation and freight? Now here I arrive at my CIF value. I am only going to think that to manufacture this calculator, what costs my exporter would have incurred. Plus, obviously, he would not be selling me at cost. He would be charging certain profit from me. So what is the general profit margin that people in US keep for calculators? I will add this, and this is known as computed value. So see, deductive value. Deductive value, we start from resale price in India. We reduce the expenses in India and come to CIF value. In computed value, we start to think as if we are in exporter's factory. Now what all costs we would have incurred till the port of importation, we keep adding these costs and we come to computed value. So here normally by chronology, first you take deductive value, then you take computed value. Why? Because what costs you have incurred, you know easily. You cannot think of what cost your exporter has incurred, but you already know what cost you have incurred. So rule 7 would always be easier to apply as compared to rule 8. But there can be certain cases where you and exporter are at a very good terms, or let's say they are your subsidies somewhere related to us, or something they are related to you, they're your subsidiaries, so you exactly know their cost breakup also. So in this particular case, it would be easier for you to apply rule 8 before rule 7. So in these cases, you can make application to proper officer, allowing you to calculate value as computed value. If unable to do this also, then final last option we are left with is rule 9, which is residual method, saying that if valuation is not possible by applying rule 3 to rule 8, then we cannot do anything. We can just simply use our best judgment, whatever data, whatever provisions we know available with us. Based on that, we will be determining value under customs. So if valuation is not possible by any other method, determine using any of the reasonable means, which is consistent with the principles and general provisions on the basis of whatever data is available to you. This was about rule 3 till rule 9. Now, this is important for theory. They might ask you sometimes this in theory, which is no value shall be determined on the basis of, see, we saw identical units, we saw similar units. Now here we've come to reasonable residual method, means whatever is your reasonable judgment. Your judgment should never depend on these cases. You cannot take base of these particular things to arrive at value using residuary method. First, they are saying selling price in India of goods produced in India. So today I can manufacture this calculator in India also. I can import this calculator from outside India also. Now I am unable to determine the import value. In none of the case you would ever consider that this manufactured calculator in India is sold for this. So let's take this only as the imported value. No, because I explained you the dynamics, the economics of every country is different. So even if the similar category of goods is being manufactured in India, you cannot take the selling price of India for the goods which are produced in India. System which provides for acceptance as the highest of the two alternatives. See, understand, till now whatever we've studied, we've taken lowest value, right? Even if they are in same commercial level, we take lowest of the values in same commercial level, lowest of the value that we sell in aggregate quantities, because that is beneficial. Lower the value, lower will be the customs duty. So you cannot accept any of the system which talks about highest of two alternatives. This is what they are saying you cannot do in residuary method. So one, you cannot take the selling price in India of the goods produced in India. Two, you cannot take any system which calculates the value as highest of two alternatives. 3, price of goods on domestic market of exportation. So I say that this calculator is sold in US. This calculator is sold in US for, let's say, $30. So this calculator is sold in US for $30. This is not at all relevant for us, because the exporting country can sell those goods in domestic market at any particular price, because there would be no freight, no transportation, no insurance, packaging would be different. So all of these things we need to consider. So you cannot take the domestic price of the exporting country, right? Cost of production other than rule 8. If you are going by computed value, do it by rule 8. There is no other alternative to computed value which you can use. So if you are starting with to use cost of production, do it as per rule 8 only. Price of goods for export to country other than India. Now USA exports calculators to India also, and it exports calculators to China also. So at what price US is exporting to China would never be relevant for us under residuary method. If one country is exporting the same goods to some another third country, it is not relevant to us, because again the distance and conditions would be different. Also, all countries have certain kinds of arrangements, MOUs done. So we never know what arrangement, what MOU they have done. Minimum customs values or arbitrary fictitious values. This is not what you can take. Other than this, based on reasonable judgment, best method, whatever you think. If unable to apply rule 3 till rule 8, then you can use rule 9 residuary method to arrive at your value under customs. Right. Declaration by the importer or his agent means you need to give a declaration. Whatever value, whatever data we are providing are full and true to our knowledge. This kind of disclosure you are required to make. So declaration by importer or his agent disclosing full accurate value of imported goods. Confiscation, penalty, prosecution possible. See, if you give any wrong information, anytime your goods can be confiscated, penalties can be levied on you, prosecution is also possible. Rejection of declared value So in what cases? Whatever value you declare here, can be rejected. It is very much simple. If the officer has a doubt, that you are declaring significantly high or low or abnormal values, so significantly higher value at which identical similar goods are imported. Now, you are saying that your goods are imported at $100. You are declaring a value of $100, but officer can see that other people importing identical goods, similar goods, are importing it for, let's say, $180. Why are you showing less price? In this case, officer can obviously reject your declared value. So significant other goods are being imported at other prices, but you are declaring some different price. Or let's say there is some abnormal discount being involved. You are saying that your supplier is giving you discount, but the discount seems abnormal reduction. In that case, your declared value can be rejected. Or the sale involves special discounts limited to some exclusive agents. There is misdeclaration of goods, means the description quality is not properly disclosed, or there is fraudulent or manipulated documents, non-declaration of parameters, what brand, grade, specification, which actually has relevance to value. You have not declared all of these. So your declaration, whatever is your value declared, can be rejected in this particular declaration if you are doing any of this particular thing and the officer has a significant doubt being raised. Declared value shall be accepted, but if you can prove in inquiry, if you can prove no, it is nothing like the case, there's a genuine discount or there's a genuine description, in that case your declared value can be accepted again if you can satisfy the proper officer that whatever I have declared is accurate only. Done. Now, determination of assessable value in case of sale of warehoused goods before clearance for home consumption. Now, this we have already covered in the chapter of importation, import and export under GST. I have already covered this point, saying that whenever you import certain goods, you have two options. Either you can clear the goods directly for home consumption, or you can keep the goods in warehouse. Once you keep the goods in warehouse, if you do a bond-to-bond transfer, is GST levied on this? Chalo, quickly tell me. Say yes or no. Yes or no, once I deposit my goods into a customs warehouse, the goods are in warehouse. And while the goods are in warehouse, I make a bond-to-bond transaction and sell these goods to someone. Will GST be levied on this bond-to-bond transfer? The answer is no. We have studied negative list under GST, which is FB changes. So Schedule 3 of GST talks about FB changes. B means bond-to-bond transfer. So on bond-to-bond transfer, no GST is being levied. And I've also taught you this, that ultimately the buyer when clearing the goods for home consumption will be required to pay GST. On what price? On the original imported price or this transaction price, whichever is higher. This was about GST. What about customs? Customs, they are saying, say for example, the goods are imported for 10,000 rupees. Kept in warehouse. Now, when the goods are in warehouse, we have made a bond-to-bond sale. For, let's say, 15,000. Customs will be applicable on what value? Because we understand customs duty is levied while filing ex-bond bill of entry. When I ultimately clear the goods for home consumption from warehouse, at that point of time, I am required to pay my customs duty. Will it be on 10,000? Will it be on 15,000? The answer is it will be on 10,000 only. Because import duty is always to be levied at the value which is at the time of importation. Subsequently, you deposit your goods into warehouse, you sell it at some other price, it is all irrelevant. Whatever will be the original import price, always import duty will be paid on that price only, even if you deposit your goods into warehouse and sell it at some another price to some another person. Quickly tell me yes or no. Yes, ma'am. Export valuation rules are all similar to import rules. You take rule 3 transaction value, not able to determine, you take like kind quality, computed value, residual method, declaration and rejection of the declared value. So every single thing that we study for import, as it is applies to exportation also. Exportation, they do not have a separate rule for like kind quality and identical and similar goods. They've simply given one rule only saying that like kind and quality. Now, other than that, computed value, residual method, everything is same as it is for exportation. Yes, everyone with me. Cool. Now this table extremely important. So for any of the question that comes in examination from valuation chapter, any of the question that comes in examination from valuation chapter, you will be requiring two things. One table that I taught you for rule 10 adjustment, and another would be this table used for determination of rate of duty and rate of exchange. Now understand, whenever we are importing, forex is involved, right? Say for example, I import goods from US, I'd be paying amount in dollar, but customs duty is paid in India. I'd be requiring to pay that duty in rupees. Now I imported goods for $1,000. I imported goods for $1,000. Now what exchange rate I have to take to convert these $1,000 into rupees? The date when I made contract with my exporter, the day when the ship left the port of exportation, the day when the ship arrived at the port of importation, when I am filing bill of entry, what will be my relevant rate of exchange on what particular date? Now first of all, you always have to take CBIC rate of exchange. The question would give you RBI rate, interbank rate, CBIC rate. They might give you any of the exchange rate. Your vision has to be very much clear. Focus on CBIC exchange rate only. So all of the other exchange rates would be irrelevant to us. What is relevant to us is the CBIC rate of exchange. Another question, CBIC rate of exchange can be given for multiple dates, maybe for bill of entry, for entry inward, for into bond bill of entry, for ex bond bill of entry. So what date CBIC rate of exchange I am required to take? So if the goods are cleared for home consumption, if the goods are directly cleared for home consumption, whatever is your date of filing bill of entry, whatever is your date of filing bill of entry, this date CBIC rate of exchange you are going to take. So if the question tells you bill of entry is being filed on, let's say, 10 August, then but ultimately I took the goods on, let's say, 12 August, or the vessel arrived at 11 August. So they have given you different dates CBIC rate. You have to take the CBIC rate of exchange as on the date of filing bill of entry. Why so? Because duty we always pay along with bill of entry. We always pay the duty along with bill of entry. So at the time of paying duty, whatever is my rate of exchange, that only I will be considering. Alright. Now talking about rate of duty, means when the ship left the port of exportation, the basic customs duty was 10% on these goods. Government came out with a notification, changed the rate to 15%, changed the rate to 20%. What rate I am required to take? So the rate of duty relevant on what date I am going to take. So here in case of vessel, they are saying bill of entry or entry inward, whichever is later. See, normally we know we file bill of entry one day prior to the vessel arriving into India only. So in normal cases, bill of entry would be earlier than entry inward only. But there are also cases possible that after entry inward, within 24 hours also you can file bill of entry. So whatever is the case, in case of vessel, bill of entry or entry inward, whichever is later. In case of aircraft and vehicle, we know there is no concept of entry inward, there is direct landing. So in this case, bill of entry or the arrival date of aircraft vessel, whichever is later. On this particular date, whatever is the rate of duty, in force, that rate of duty you are going to take. And rate of exchange, to convert dollars, euros, pounds, whatever into rupees, you are going to take CBIC rate, and without any doubt, the rate existing on bill of entry. So whenever you file your bill of entry, on that particular date, whatever is the rate of exchange, that you are going to take. But for rate of duty, it would be bill of entry or entry inward, whichever is later. Right. Now, goods cleared from warehouse. Very much simple. If you deposit your goods into warehouse, we understand that at the time of filing into bond bill of entry, you are not required to pay any duty. At the time of filing ex bond bill of entry, you are required to pay duty. So the duty existing on the date of ex bond bill of entry, this duty you will take. And rate of exchange, you are going to take into bond bill of entry. So today when I deposit my goods into warehouse, today only, whatever is the rate of exchange, it will get fixed. So if $1,000 goods I have imported and I deposit into warehouse today, filing into one bill of entry, my rupee conversion rate is fixed, but my rate of customs duty is not fixed. Customs duty would be whatever will be my ex bond bill of entry. Very much simple. So if you directly clear your goods for home consumption, and I'm repeating this again, this table is extremely important. More than 70% of the questions would be related to this table, where you have to make determination of rate of duty and rate of exchange. So when the goods are directly cleared for home consumption, the rate of duty would be later of bill of entry or arrival or entry inward, whichever is later. But for rate of exchange, always CBIC rate on the date of filing bill of entry only. Goods cleared for home consumption, simple. Rate of exchange into bond. Rate of duty, ex bond. Export, so whenever you get your let export order, you simply pay your duties. So your let export order date will be your relevant date for export. Now this normally does not come in question also. More relevant would be point 1 or 2. In 1 or 2 question you might find export duty. So simple. Shipping bill date would be your relevant rate date for exchange rate, and let export order date would be your relevant date for rate of duty. Now if there is any other residuary case left, then whenever you actually pay the duty, take that date only, because normally everything is covered in this point. If certain other duty any time appears which you are required to pay, you cannot do anything. Whatever is your payment date, that only will become your relevant date. Done. Now, section 19, special provisions for classification of set of articles or accessories. See, understand, I import a set which have 5 articles. Now, if my articles are leviable to duty with reference to quantity, see, understand, government has already prescribed that for 1 unit, for 100 grams, for 200 grams, this is what you are required to pay. And if I import 2000 grams, 2 kgs, with respect to whatever is the quantity, I will be paying the amount. But if the articles are liable to duty with reference to value, which normally happens, that on this particular value, this percentage of duty you are required to pay. Now, whatever goods I have imported in this set, so I have made a set of 555 goods, where let's say I have a nail paint, I have a blusher, or I have 5 different kind of products being merged in one set. If all of them are applicable to same rate of duty as per HSN code, there is no doubt only on this entire set amount I will pay that duty. So if all of my articles in this set are leviable at same rate, there is no doubt, because that same rate I will pay. If they are leviable at different rate, then treat it just like a mixed supply under GST. What we do under mixed supply of GST, we take the highest rate, right? Same principle applicable here also. So they are saying that if you merge certain things into sets, if you merge certain articles things into set, in that case, if all of them are leviable to same duty, apply same duty. If not leviable to same duty, then you take the highest duty. Or let's say there is a set. There is this set where there are 5 articles. Now this particular article is not leviable to duty only. Means that it can be possible that certain goods are exempt under customs. Yes. So this particular goods is exempt only. Then what to do of this? They are saying whatever you do with these 4, you do with this also. Say for example, same rate is applicable on all of these 4. You apply that same rate to this also. Or same is not applicable. So whatever is the highest rate, you apply on this also. Means now, because it has now become a part of set, it will no longer be exempt. Once it becomes a part of set, it will no longer be exempt. So they are saying if articles are not liable to duty, then also chargeable at the rate to which other articles are liable under clause B. Can I simply tell you, this is a kind of mixed supply under GST. So whatever we study under mixed supply under GST is similar to when you make all of these sets. Now this is similar to composite supply. Now here they are saying that I am not making a set, but there are certain articles or parts or implements. Like today, if I import a calculator, I will be getting a cell inside the calculator. Yes, cell can be imported separately also. So they are saying, if there is some article or part or implement which is compulsorily supplied along with the main article, there is no separate charge for it. Can I treat it just like composite supply? Yes, which means that the main article and the article, parts and implement would all be chargeable at same rate only. All of them will be chargeable at same rate only, because this article is compulsorily supplied with the main article, and they are not even adding any separate charge for that. But if they are not considered, they are not compulsorily supplied, you are compulsorily or let's say you are deliberately making a combo of them. They are not always compulsorily supplied, they are optionally supplied, but you are optionally supplying it, and there is no separate charge. In this case, we understand highest rate, it will become chargeable. So if these articles are not compulsorily supplied, optionally you can opt to supply this, or you can also supply both of them separately also. Then in this case, we are saying that the highest rate will be applicable, means we are deliberately making a set, we can understand. But if they are charged separately, now they might be compulsorily supplied, they might not be compulsorily supplied, but if they are charged separately, then they will be leviable to duty at their individual rates. Best example we can take of charger. See, normally all companies today give charger with mobile. Charger is an article or a part of implement of mobile only if I buy mobile. Talking about Apple do not give chargers. They sell chargers separately. So for normal companies, I would be saying that charger is compulsorily supplied along with mobile only, and we do not even charge any separate consideration. So if the mobile today is worth 50,000, that 50,000 would automatically include charger also. So here, treat it like a composite supply, and the mobile plus charger will be leviable at the same rate. Talking about Apple, now in this case, Apple sells charger separately, means it is optionally supplied, it is not compulsorily supplied. Now in this case, even if Apple is not charging for any separate amount, still main article and the charger, whatever is the highest rate of mobile or charger, of this highest rate, both will be chargeable. But say for example, let's take example of Vivo, which normally gives charger with mobile only, but for this particular consignment they are giving mobile and charger at a separate rate. Then you do not have to think anything and apply the individual rates, because they have only given breakup that of this 50,000, 47,000 is for mobile, 3,000 is for charger, or let's say in case of Apple, this X amount is for mobile, Y amount is for charger. So then we are not going to see whether they are optionally supplied or compulsorily supplied. Why? They are giving us the breakup, they are charging separately, so apply individual rates to both of them. This is same concept, same concept that we study under composite and mixed supply under GST. There also I had taught you this, that if you charge certain things separately, always, means you are not clubbing them, then obviously all of those supplies will be charged at their individual rates only. So here we complete our chapter of valuation. There are these customs valuation assistance rules being added, but they are not much relevant for your exam point of view. You can just refer with the exceptions once. These are simply saying that if you do any wide eye means if you do any hoshiyari chapla, whatever you call it, so means you are not declaring your transaction value properly. Now in this case, they are saying that the officer is going to determine your value. Officer has the power to determine your value using the assistance in value declaration of identified imported goods. So the process to be followed before the board may specify a class of importers, that when we believe that you are not accurately declaring your values, or there is some certain would say fraud or something like this going on, simply if found by screening committee finds suitable that they need to determine your value, they can determine your value, but exceptions apply. See, if there are imports which are not involving duty only, then why to put importer under unnecessary processes? Anyways, no duty is being paid on these particular goods. So these are some basic exceptions which do not apply, but normally officer can take this customs assistance rules ka help to determine the value under customs. Now it's just empowering section, means this part has no potential of being asked in exam as such. You can just go with the exceptions once, maybe that would be relevant for MCQ purpose to you. Other than that, this is amendment for November 23 exam, means this ICAI has issued an amendment booklet, but for exam I do not find it much relevant except for the exceptions. You can just give a plain reading once. Other than that, the chapter is completed. But as I already mentioned, no matter how many times you read the provisions of valuation chapter, unless you solve all the questions 2 to 3 times, you are not going to gain confidence. Now, if you solve all question 2 to 3 times, in fact, it is possible that one day before exam you need not even look at the provisions, because you know how to solve the questions, and that is what is important for valuation chapter. So here we wind up. We've taken more than expected time, but I wanted every single thing to be extremely clear to you. My target was to complete this in 1 hour, but we've taken 1 hour 25 minutes, which is okay, like almost 50% more than the expected time. But still, if you are all confident, then the purpose is served. So quickly tell me you've understood entire valuation chapter and we are good to go to solve the question answers of customs. Quickly everyone. Yes or no? Now these are all the ICAI SM questions. ICAI SM questions means the illustrations plus the test your knowledge questions. So illustrations plus test your knowledge questions, and this is an annotated PDF where I have highlighted the answers. Wherever I feel a small kind of calculation I can give, I have given this calculation, and this PDF I have already shared on the Telegram channel. The Telegram channel link is in description. So if you want to download this annotated PDF, you can just go to Telegram channel and download the PDF. Otherwise, anyways, you would be having ICAI module, you would be having question bank, whatever you have, you will find these same questions there also. You can just mark on your own. Right, everyone is confident. We can just take a 2 minutes break before we start with the questions. Yeah. So go get calculators, rough page, pen, everything. Taking a 2 minutes break and then we shall start with the question answers. Okay, so welcome back everyone. Let's start with the question answers of chapter 4, Valuation under Customs 1962. Sure. Messrs. IES Limited imported certain goods as US dollar 20 per unit from exporter who was holding 30% equity in the share capital of importer company. Now quickly tell me, holding 30% shares. Holding 30% shares would make them relative, yes or no? Now I want all of you to be active in the chat section and start giving me answers quickly. Then only we'll be able to understand whether we've understood the chapter or not. So be very quick, very agile to answer me. Chalo. So here if the exporter is holding 30% in importer, are they related? The answer is no. Why? Because I told you there has to be control under customs to become relative. 5% criteria is big when a single person is holding both of them, not a person A and B. If the hold is less than control, they would not be considered as related. So here the hold is 30% means they are not related. Yes. Now, subsequently, assessee entered into an agreement with the same exporter to import the goods in bulk at 14 rupees. Now, the imports at the reduced price were affected because department rejected whatever. So here the question says that normally imports are being done at $20. Normally imports are being done at $20. Because we imported in a lot of bulk amount, we were able to import at 14. And it was a 30% holding between exporter and importer. The customs officer says that you both are related person and therefore I am rejecting your $14 price and I will take $20 as your transaction value. Is the officer correct in doing so? The answer is no. The exporter company is not exercising control over assessee. The exporting company is not exporting control or not exercising control over assessee and therefore they are not related. First of all, I emphasized this point 2-3 times when I taught you related person definition, and therefore we also have a reasoning to say that we have bulk imported and that this could be a reason for reduction in the import price, and therefore unless the officer is otherwise able to prove so, the price declared by the assessee would be acceptable and the department's action is not sustainable in law. Chalo, everyone understood? Yes or no? Yes. Simple question. Now, answer the following with reference to the provisions of section 14. What shall be the value if the price rise of imported goods in international market between date of contract and the date of actual importation, but we pay the contract price only? So when we contracted, price was X, but now at the time of importation price is X plus something because the prices have raised in the international market, but we still pay the original price only. We still pay the original price only because we had contracted on this price. What will be the relevant amount of importation or the relevant value? Whatever is the contract price. So the price stated in the contract would only be taken. Why? Because this is what we had originally agreed at. Later the price is increased, which is not for which we are not responsible, right? Second, I already mentioned this also, that the contract price will always be relevant, or the price which you are actually paying. Means either if you are paying the contract price, then that. If you are paying the negotiated price, then that, because we take the value at the time of importation. Whether the payment for post-importation process is included in the value if the same is related to imported goods and is a condition to sale of imported goods, the answer is yes. So a payment for post-importation process is included in the value of imported goods if the same is related to such imported goods and is a condition of sale thereof. Mother Mary Hospital and Research Center imported a machine from Delta Scientific Equipment, Chicago for in-house research. The price was settled at $5,000. Machine was shipped on 10th April. So the shipping is done on 10th April. Meanwhile, hospital authorities renegotiated for a reduction in price. As a result, Delta Equipments agreed to reduce the price to $850. So we initially agreed at 5,000, but now we have reduced the price by $850. So it would be 4,150, right? And sent the revised price of 4,150 under a telex dated 15th April. Machine came on 18th April. So what is the time of importation? 18th April. And before that only, On 15th April only we agreed at a price of 4150. So now tell me what will be the relevant price for valuation under customs. Will it be 5,000, which is the original contract price, or it will be 4150, which is renegotiated price, and the renegotiation was done before imports only? Quickly tell me. The Commissioner of Customs is asking for duty on 5,000. He is saying that at the time of shipping the amount was 5,000, but you are saying that no duty is required to be paid on 4150. What as per you would be the amount on which we will be paying duty? Come on everyone. Yes, the answer is 4150. I want all of you to be active. Chalo, keep giving answers. So no, the commissioner's approach is not correct. Goods should be valued at the reduced price, which was the price actually paid at the time of importation. So 4150 will be the value. Now, A had imported goods from Finland. Due to deep drought at the port, goods were not taken to the jetty in the port but were unloaded at the outer anchorage. Okay. The charges incurred for such unloading at the outer anchorage to the jetty, barge charges. So they're simply saying due to any of XYZ reason, we incurred 1,35,000 as barge charges. A claims that such charges from the part of the from the port of loading and unloading charges should be deemed to be included. So they are saying it is deemed to be included. The importer is saying you do not include my 1,35,000 separately. I consider it as deemed included in the freight only. Is he correct? Is Mr. A correct? The answer is not correct. Why? Because if any of the barge charges being incurred, they will also have to be included in the cost of transportation. You cannot consider them as deemed included. Means you cannot say that whatever freight charges I have incurred, consider it in that only. This is something separate. No. So you have to separately, if separately incurred, you will have to separately include this also. I specifically told you this. Ship demurrage, lighterage charges, barge charges will always form part of transportation and you will have to include them. So A's claim is not tenable. Why? Because these charges are required to be included. Then a material was imported by air. Now we understand whenever there is a point of air. Whenever there is a point of air, one thing should always strike to you that we have to compare freight with 20% of adjusted FOB. Even they give us the actual freight, we will have to compare it with 20% of the adjusted FOB in case of air always. So material was imported by air at CIF value 5,000. Freight paid was 1,500. Insurance cost was 500. The banker realized the payment at 71 per dollar. CBIC rate was 70. Now, first of all, what is relevant to us? The banker's rate or the CBIC rate? The CBIC rate. Therefore, 71 is irrelevant and we will do conversion at 70. Now, I told you to always start the question with FOB value. They have given us 5,000 CIF value, which includes 1,500 freight and 500 insurance. So I will reduce 1,500 and 500 from 5,000 to arrive at my FOB value. So my FOB value will come to 3,000 rupees, right? 5,000 minus 1,500 minus 500 gives me 3,000. Now no other adjustment is there. Therefore this 3,000 is my adjusted FOB. This is my FOB and this is only my adjusted FOB because no other adjustment is given in the question. Now for freight. Actual freight is 1,500. Actual freight is 1,500. I will compare it with 20% of 3,000, which is 600 because it is the case of air. Whichever is lower will be 600. Therefore, even though the actual freight is 1,500, we are going to take only 600 as freight. Insurance, they have given actual insurance as 500. Therefore, we take 500. And 4100 is my CIF value and I convert it into rupees by 70 rupees rate of exchange because that is the CBIC rate and 2,80,000 rupees is my assessable value under customs. Quickly tell me yes or no. Yes, the video is going to stay on YouTube. Chalo. So quickly tell me yes or no. Everyone got the answer of 2,87,000 on calculators. As I said, they have directly given us the CIF value in the question. We require CIF value only, but we are not going to take their CIF value. We will calculate our own CIF value starting with FOB price. So CIF, they have given us 5,000, of which they have said us that the original freight is 1,500, the original insurance is 500, reduce that and you get 3,000 as your FOB. This is your adjusted FOB. You compare 20% of this with the actual freight. take lower of the two. Insurance actual given, take actual. If actual would not have been given, then we would have taken 1.125%, right? Yes. And we arrive at CIF value, and we are least concerned with the banker's realization price. The rate of exchange relevant for us would be the CBIC rate. Yes, all of us got the answer. Chalo, next question. From the particulars given, find out accessible value. X factory price they have given. Cost of machine at the factory of exporter 10,000. We know we want FOB price. So whatever they have given, if they've given X factory price, they've given CIF, they've given FS, we always will arrive at FOB first. So the cost of machine at the factory of exporter 10,000. I know this will be a part of FOB. Transport charges from factory of exporter to the port of shipment. So exporter's factory to port of exportation will also be considered for FOB value. Yes. Handling charges paid from loading of the machine in the ship. So loading in the ship at the exporter's factory. Yes, this will also be a part of my FOB value. Buying commission. See, I told you, buying commission will never ever be included. Your local commission, exporter commission, every commission will form part of CIF adjusted value, but never include buying commission. So this buying commission paid by importer will be irrelevant for us. Freight charges they have given. Now this is a case of vessel, right? This is a case of vessel because they have said port of shipment. Now shipment, if they give me actual freight, I will always consider my actual freight only. Exchange rate they have given 70, and actual insurance charges are not ascertainable. No problem. We know that 1.125% will be my actual insurance price. So first of all, I come to FOB value. So 10,000 plus 500 plus 50. So 10,550 is my FOB value, and no other adjustment because this buying commission is irrelevant. So no other adjustment is required to be made. So this FOB is only my adjusted FOB. Now two adjustments as per 10.2. Freight and insurance. This is a case of shipment. See, this was the case of air. Therefore, even if actual freight was given, we compared it with 20%. But here is a case of shipment, and I told you in ship, if actual freight is given, no need to compare. So they've given me actual freight of 1,000 rupees. I will directly take the actual freight of 1,000 rupees. For insurance, they are saying it is not ascertainable. No problem. We know that it is 1.125% of my adjusted FOB. What is my adjusted FOB? 10,550. So I simply take 10,550 into 1.125%, which comes to 118.69. Yes, and 118.69 will become my insurance amount. I add all of this, and this gives me CIF value. But this CIF value is in dollars, and therefore I convert it into rupees, and only one exchange rate they have given in question. Therefore, there is no doubt about exchange rate. So I will simply take $1 into 70 rupees, and this gives me my accessible value. Yes or no, everyone? See, this is a case of vessel. I have also given certain small margin notes for your later reference that it is a case of vessel, and therefore take actual freight. No need to compare it with 20% as we did in the previous question, because that was the question of air. And always in exam, you have to write these kinds of working notes, that how did you arrive at this particular value, you take this, then buying commission will not be included. All of these notes, you understand, you have to write in examination. Done. Next question. The only question with respect to export duty valuation. Because normally in exam also you see questions related to import duty only. This is one question given in module for exports. Let's see. Compute export duty from the following data. FOB price of the goods they've given $1 lakh. Shipping bill presented on 26 April. So this 26 April is my shipping bill date. Proper officer passed order permitting clear and loading of goods, means let export order was given on 4th May. Okay. Rate of exchange and rate of duty they have given. Make suitable assumptions and calculate my export price. Okay. Now see here. First of all, I taught you that table where point number 1 for home consumption, point number 2 for warehouse, and point number 3 was for export. Saying that shipping bill date will be relevant for rate of exchange, and let export order date will be relevant for rate of duty. So first of all, we understand that 26 April, which is my shipping bill date, will be relevant to determine my exchange rate. Therefore, the exchange rate relevant for me would be 70 rupees per dollar, and my let export order date, which is 4th May, will be relevant for my export duty rate. Therefore, export duty applicable would be 8% and $1 is equal to 70 rupees. If you do not remember that table, your question is stuck here only because they've given you two rates and two rate of duty and two rate of exchange. What to take when? For that, you need to remember that table which says that shipping bill date for rate of exchange and let export order date for rate of duty. Understood? Now simply they've given the FOB price of goods to be 1 lakh rupees, 1 lakh dollar. I convert 1 lakh dollar into 70 lakh by applying 70 as my exchange rate, and my export duty is simply 8% of this. Hey ma'am, mistake. Why did you not consider freight and insurance? Come on quickly, anyone. This is a case of export duty. Once I export the goods from my port of exportation, I am done, I am free. Why would I anytime pay duty on my freight and insurance? Because the importer is going to pay on the same. Now, when we are importer, we pay duties on freight and insurance. Then when we are exporter, we cannot again pay duties in this particular cases because the liability to export extinguishes once my goods are exported. Therefore, in case of export, you need not include any time freight or any of the insurance charges. The question of export is extremely simple. Take FOB price, consider the relevant rates, convert the amount and 8% is the duty. So 8% of 70 lakh, 5,60,000 would be my export duty. Simple question. Chalo next. A consignment of 800 metric tons of edible oil of Malaysian origin was imported by a charitable organization in India for free distribution, whatever it is, being a special transaction. Since it was for some philanthropic purpose, the special transaction took place at only $10 per metric ton, right? But we understand that this is not acceptable value as per customs because this is a reduced value owing to a special transaction, because they've put a condition saying that these goods will be used for philanthropic purpose only. Therefore, the transaction value of 10 will be rejected. Now they've given us that the quantity imported in metric tons is 20, 100, 500, 900, 400, 780, whatever. And our actual import is of 800 metric ton. So we understand that all of these are somewhere about same commercial level of 800 only. Now it is a matter of judgment. So we consider that 500 to 780, somewhere all of these are of same commercial level only, means nearer to 800 only. And now we have different transactions value available for this. What we do? We take lowest of all. And therefore lowest of all would be 160, for which 780 units are imported, and it is also at about same commercial level of 800 only. Therefore 800 into 160, $1,28,000 gives me my CIF value. Now rate of exchange, they have directly given 70, customs duty directly they've given 10. So I convert 1,20,000 multiply by 70 into INR and apply basic custom duty at 10%. And even if the question does not specify, we know that 10% social welfare surcharge have to be levied. So on this basic custom duty, I take 10% social welfare surcharge, and this is my total customs duty. Simple question it is. You just have to remember that whenever we take values of identical or similar goods, we have to consider first of all the same commercial level. If there are one or more items available at same commercial level, we take lowest of the all price to determine our transaction price. So we had all of these, see 900, 400, 780, all of these are at same commercial level only with 800. So all of these are same commercial level, but we will have to take lowest of all. Understood? And then there's no rocket science involved here because they have directly given us the exchange rate and the basic customs duty ka rate. Understood? Sure. So this is the final calculation that they've done. I've made it extremely simple for you by giving the annotations. Next question. Foreign Trade International Limited has imported one machine from England. It has given the following particulars. So the price of machine is 8,000 UK pounds. Freight paid air. Okay, so we know that even if actual freight is given, we will compare it with 20% of adjusted FOB, right? Design and development charges paid in UK. See, I told you include all design development charges other than India. If design development charges incurred in India, we are not going to include that. But design development charges incurred in UK, yes, we are going to include it in the adjusted FOB. Understood? Commission payable to local agents of exporter at 2% of the price of machine. Yes, Krishna, it will be covered today only. After valuation, we'll be doing warehousing and duty drawback also in this particular session only. So, commission payable to local agents of exporter at 2% of price of machine in Indian rupees. Understood? So, they are saying whatever is my price of machine, whatever is my price of machine, of that 2% commission will be payable. On my price of machine, 2% commission will be payable. And I told you, except for buying commission, all of other commissions will be included. So this is not a buying commission, this is a normal commission, a local agent commission. Means we are going to include that also in my adjusted FOB. So here 8,000 is my price of machine, plus I understand that 500 design charges because they are incurred elsewhere in India. I will include that also, and plus 8,000 ka 2%, which is the commission, on price of machine. This also I am going to include. So 8660 UK pounds is my adjusted FOB. 8660 is my adjusted FOB. Now I compare 20% of 8660. What is 20%? What is 20% of 8660? It is 1732. So 1732 is my 20%. I compare it with the original freight, which is 2500. So 1732 compared with 2500, which is lower. Whatever is lower is 1732, and therefore my freight would be 1732 that I am going to take. Plus insurance. Insurance again would be 8660 into 1.125%. So insurance here is 97.43. 97.43 is my insurance, which is 1.125% of FOB. So 9743.5 means this 8660 I am considering in thousands. Okay. So now, okay. So here I convert. They have given me the rate of exchange. Yes. See. So bill of entry. Bill of entry, they've said 24th October and arrival of aircraft is 20th October. Understood. So first of all, to take rate of exchange, we always take the date on which we file bill of entry. So bill of entry is filed on 24th October, and therefore the rate of exchange relevant would be 100 pounds, right? If you remember the table, if you simply remember the table, it is very much simple, saying that for duty I will take bill of entry or entry in words, whichever is later. But for rate of exchange, I always take bill of entry. So rate of exchange is fixed at 100 per UK pound. And for duty, I will say arrival of aircraft and bill of entry, whichever is later. So arrival is on 20th October and bill of entry is on 24th October. So later is 24th October. And therefore basic custom duty of 10% will be relevant to us. Other than that, they've said IGST at 12% and insurance charges are not ascertainable. Do not worry, even if they are not ascertainable, we know we are required to take 1.125%. So very much simple. The relevant exchange rate is 100 for us, and the relevant basic custom duty is 10 for us. So very much simple it is to take 8660 plus we will do 1732 plus we are going to do 97.425, whatever was the insurance. I make a total, I multiply it by 100. You can convert anytime you wish. See, here I have converted originally only. So I did 8660 into 100. I converted here into INR, and then I compared everything in INR only, which is okay. Whenever you want to convert the amount, you can do. Your ultimate answer always is going to be same only. Now this is my CIF value. Which is 1048942. So 1048942, this exact we have matched with our suggested answer. Now nothing is left. Now types of duty chapter starts. So now we know that 10% is the basic custom duty. So I will take 10%. I will take 10% of my basic custom duty, 10% of this as my social welfare surcharge, make a total and take 12% IGST, 12% IGST of this total amount, Now basic custom duty plus social welfare surcharge and plus IGST. All of this total will give me my total duties and taxes payable. So simply the main thing is to come at CIF value. Now once you come to CIF value, then types of duty chapter starts, which says that apply basic custom duty on CIF value. Then apply social welfare surcharge on the duty only. So on this basic custom duty, I apply 10% CIF. I make a total of all of these, and on this total, I take 12% as my IGST, and my final duties payable would be BCD, social welfare surcharge plus 12% IGST. It will not make a difference. See, even if you convert it, they are saying that the commission of 2% is payable in Indian rupees. Even if you convert it earlier, you will be taking 100 rupees as the conversion rate, right? You will be taking 100 per UK pound as your conversion rate only. So even if you want to start your question like this, 8,000 into 100, then 500 into 100, or 8,000 into 2% into 100, it will be irrelevant, or the answer would be same. Means you would be indifferent only because the conversion rate is same. So going by this means try to convert at a point which is more suitable for you, or where the calculations are less. If they would have directly given us commission in INR, see, certain questions they will tell you that 500 rupees is the commission paid. There you will not be left with an option, because for adjusted FOB you need one currency, right? If they have given you FOB value in dollars, but they have given you commission in rupees, in that case you cannot find CIF in dollars only. In that case you will have to convert this also into rupees, then add this and bring entire total in rupees. Here, because percentage was there, even if I would have converted, it would have given me the same answer only. So if question gives half data in rupee, half data in dollar or pound, then it would be advisable to convert as early as possible. But the question is giving you data in percentage terms, then it is okay you convert at last only, so that everything is converted all together only. So you have multiple options available here where you want to convert. It will not make a difference. Your ultimate CIF value and your total duties should match. I hope I have made this point clear to you. Done. Sure. Next question. Compute the total duty and integrated tax payable under customs law. Assessable value. See, again they have directly given us the assessable value, which is $10,100. Bill of entry is 25 April. On this, basic custom duty and exchange rate is given. Okay. Entry inwards is 25th April, 1st April. Now, first of all, we know rate of exchange. Rate of exchange always will be bill of entry. Rate of exchange always will be bill of entry. Therefore, 65 will become my rate of exchange. Now, duty. For duty, I will see entry inward, bill of entry, whichever is later. So, entry inward is 21st April. Bill of entry 25th April. Later is 25th April. And therefore, basic custom duty 10% will be applicable. As I said, that table is extremely important. If you do not know that table, you will be stuck in every single question. Just remember, bill of entry always for rate of exchange. For rate of duty, it will be bill of entry or entry inwards, whichever is later. So I understand 10% is my basic custom duty applicable and 65 is my rate of exchange. Integrated tax 12%, social welfare surcharge 10%. Make suitable assumptions, round off to the nearest rupee and calculate the duties. Now, ideally, this question is not of valuation chapter. This question is of types of duty chapter, I would say. Except for this point. Why? They have not given us any information with respect to freight, insurance, anything. Means they have directly given me CIF value. But there is no original freight, original insurance being given in the question. So I cannot even do back calculation to go at FOB. What back calculation I will do? If I consider 20% or 1.125%, go back calculate, add it again, it will again bring me to this particular value only. Since there is no another adjustment that we studied in the valuation chapter, we directly start with this CIF value. The only catch here is at what rate to convert. So the rate to convert would be 65 rupees. So $10,100 into 65 I will do, which will give me CIF value. On that, I will take 10% basic custom duty. Even if the question does not say, I know that 10% social welfare surcharge I have to charge on this particular amount. Make a total of all three, levy IGST on this amount, and ultimately basic custom duty plus social welfare surcharge and plus my IGST will bring me to the total duties payable rounded off to the nearest rupee. Quickly tell me, understood. This is a pure C category question. a pure C category question where everything they have given, CIF value in fact they have given. You only need to know that what will be the date and rate relevant. Other than that, everything you already know. Are you feeling confident with the questions? Quickly tell me. This is what is going to come in exam for 5 marks. Are you feeling confident? I'm saying minimum 5 marks. The weightage can go to 10 also. Done, ma'am. Understood. Okay, sure. Now assessable value of an item imported is 1 lakh. Basic custom duty 10%, IGST 12%, social welfare surcharge 10%. Compute the total customs duty. Are we even required to solve this question? Everything they have given directly, no other adjustment to be done. C category question it is. 1 lakh is my CIF value. 10% basic custom duty. Even if the question does not mention, I know 10% social welfare surcharge on that. So assessable value is 1 lakh plus 10% basic custom duty 10,000 plus 10% social welfare surcharge of this would be 1,000. This will bring me to 1,11,000. IGST they've told me 12%. So 12% IGST. Have they given? Okay, yes, this is 12% IGST. So 12% of this I make a total reduce from the assessable value and I get my so the total customs duty plus social welfare surcharge plus IGST will give me my total duties and taxes to be paid. I am not even required to make a conversion here because they have not given me dollar rupee exchange rate also. Extremely simple C category question it is. Done. Next question. From the following particulars, calculate total custom duty and IGST payable. Date of presentation of bill of entry. So I know that my rate of exchange will always be my bill of entry. But here see, they've given me interbank rate also and they've given me CBIC rate also. I know that my bill of entry date will be rate of exchange. But which rate of exchange? It will be my CBIC rate. And this interbank rate would be irrelevant. Right. But for customs duty, I will compare bill of entry or entry inward, whichever is later. So entry inward means the arrival of aircraft is on 30th June. Bill of entry is on 20th June. Whichever is later is 30th June. Therefore, customs duty would be levied at 10%, but rate of exchange is 70 rupees. Understood with that table. Done. Integrated tax 12%. Ignore compensation. ठीक है. CIF value they've given $2,000. Air freight. See, now they've given us air freight. Air means I will have to compare actual with 20%. They have directly given me CIF value. Therefore, I will begin my question by arriving at FOB value. So CIF value is 2,000 rupees. I will reduce freight of 500. I will reduce insurance of 100. So 2,000 minus 500 minus 100 will give me 1,400. So 1,400 is my FOB value. So I will always start my question with FOB value, arriving at FOB value which is 1,400. Now I will compare actual freight with 20% of 1,400. So 1,400 into 20%. 1,400 into 20% gives me 280 rupees. But the actual freight is 500. Whichever is lower, 280 or 500, 280 is lower. Therefore, the freight would be 280 rupees. Plus insurance, I will take actual which they have given as 100. Therefore, 1,400 my FOB value plus 280 plus 100, which gives me a CIF value of 1780. So I arrive at the CIF value of 1780. Now I know rate of exchange is 70. So I convert 1780 into rupees by multiplying it into 70. I arrive at the rupee assessable value. Basic custom duty is 10%. So take 10% of this as basic custom duty, 10% of basic custom duty as social welfare surcharge, and I add all of this, and GST rate also they've given me as 12%. See, the catch only is to calculate CIF value. Once you arrive at assessable value, all of this is monotonous that you do in every question same. Apply the basic custom duty, take social welfare surcharge, add all of this, apply integrated tax, and then add customs duty plus integrated tax to arrive at the total duties that you are required to pay. So this calculation you will not make a mistake. I would say the room to make a mistake would be to arrive at assessable value only. So again, this is kind of a C category question only. Somewhat similar to this we've already done. We already did, I guess, question number 3 or 4, which was similar to this only. where we had first reduced the amount, arrived at FOB, compared my actual freight with my 20% of adjusted FOB. Done? Clear? Sure. 15,000 chalices were imported for charitable trust in India by XY charitable trust. The trust did not pay either for the cost of goods for design development charges which was borne by supplier. Okay. Customs officer computed FOB value at 20,000 including design and development charges which was accepted by trust. Okay. So the freight paid first of all is 4500. They have given us FOB value only. They have given us FOB value at $20,000 which also includes design and development charges. Understood. So design development charges are paid in USA. Design development charges are paid in USA which is 2500. They have already included this. And we know this was actually supposed to be included. So the adjustment is done. See, they are saying that this 20,000 is including design development charges which we have paid in USA, means paid in elsewhere in India. So this was required to be included and this they have already included also. Means I am not required to include it again. Otherwise it would be twice inclusion. Commission payable to an agent in India. Now this is not a buying commission. This is a normal commission. Therefore this commission I will include in FOB. The answer is yes. Now understand this is in Indian rupees. All of this data, the thing that I was explaining in the other question, that if they give you commission in rupees, now I am not left with an option to continue my question in dollars, means I will have to convert compulsory everything in INR. So here I start with 20,000 which is my FOB value and then I convert it into INR. Now this thing, I think now we are very much clear that my bill of entry will always be my exchange rate relevant and later of the two, 30 September or 8 September, later of the two will be my basic custom duty rate. So I convert 20,000 into INR plus I add commission payable to agent in India which is 12,500. Ma'am, why did you not add this design development charges? Because the question is saying it is already included and therefore I need not include it again. Understood. So this is my adjusted FOB. Now, is the import being done by air? Yes, the answer is import is being done by air. Therefore, I take 14,12500 multiply by 20%. It comes to 282500. So the 20% of adjusted FOB is 282500. Actual freight they have given is 4500, but 4500 is dollars and this amount is INR. So to compare, I need both either in INR or both either in dollar. So I will convert 4500 into INR. So 4500 multiply by my exchange rate is 70. So 4500 multiply by 70 I do, which is 3,15,000, right? Which is 3,15,000. So what is lower of the two? Lower of the two, because it is case of air, the lower is 282500 and therefore my freight will be 282500. Insurance actual they have not given, therefore I directly take 1.125% of my CIF value as insurance. I add everything, I arrive at CIF value and after that the question is extremely simple. So once you arrive at CIF value, then there is nothing much to be done. We know that the basic custom duty will be 10%. So I simply take 10% of my CIF value. I take 10% of this as social welfare surcharge, add everything. IGST they have given in question which is 12%. So I take 12% as IGST and I tell them the total duties applicable. Quickly tell me yes or no. Understood everyone, when to convert in INR. When certain data is in dollar, certain data is in rupee. At that point of time, it is advisable to convert early into rupees so that all the remaining calculation can be done in a single currency. But if the question is giving percentage terms data, then it would be simple to first of all complete the calculation in dollar, pound, whatever foreign rate they've given, and then at last you convert it into INR. Here, because it was not possible for us, because any other commission which we have local commission paid in India, they've given in INR. Other data they've given in dollar, and therefore it became mandatory for me to convert the amount into INR. Yes or no, everyone? Done, understood. Now this question, there's an error in module. The answer will match anyways. Why? Because in this question, it is a question of air or ship. I'm not sure. Whatever it is, I guess it is a question of air only. Yes, it is a question of air, where we compare actual freight with 20% and the actual freight is lower. So once you calculate adjusted FOB, you take 20% of this adjusted FOB, compare it with actual, and actually the actual freight is low. Hence we take the actual freight. Therefore, answer is not making any difference if you compare it with module. But what ICAI has done, they have taken commission. They have taken commission payable to local agent after FOB. This is a module illustration only. So if you see this illustration in ICAI module, for now, till ICAI has not issued new module, till now what they have done is, they have taken this commission after freight and insurance. Still the ultimate answer is matching. Why? Because actual amount is lower. Ultimately everything is getting added. But this question could have gone wrong as per ICAI if 20% amount would have come less. I have corrected this here. So you please make sure to add commission before FOB value only. ICAI has done this error. We are not going to make it. Okay, sure. So Mr. Backpack imported second-hand goods from a UK supplier by air. Done. Which was contracted on CIF basis. However, there were changes in price in the international market and we took a lot of negotiations. Okay. So CIF value, air, freight and insurance they have given. First of all, we know that for us what is relevant is the FOB value. They've given us contract price, they've given us changed price and they've given us negotiated price. The original import took place at the negotiated price. Therefore, what is relevant for us? Contract price? No. Changed price? No. Relevant for us is the negotiated price. But again, they have given us 5,500 as CIF value. Freight and insurance is given. So I reduce 500 as freight and 600 as insurance and arrive at 4,400, which is FOB. So I have here 4,400 pounds. 4,400 pounds as my FOB value, which is relevant for me. Both of these are irrelevant because I need to take the value at the time of importation. Done. So 4,400 is my relevant FOB value. Now, other details for computing assessable value they've given. Vendor inspection charges, inspection carried out by foreign supplier on his own, not required under a contract. Now understand, vendor can do anything that he wants. A vendor can do anything that he wants. It is not on the buyer. Same concept applies in GST also. If you remember, in GST valuation chapter, I have taught you, if any expense being incurred by seller charged from buyer, then we include it in the value of supply. But supplier on his own wants to incur any expense which is not a condition of our contract, then that we are not going to include. Same thing they are saying. Vendor has incurred inspection charges, but he has done it on his own. There was no obligation. It was not required under contract, and therefore we are not going to include this 600 as vendor inspection charges. Commission payable to local agent at 1% of FOB in local currency. Now here they are saying that the commission is payable at 1%. Commission is payable at 1% of the local currency. Now see, again, they have given us percentage. So you very well have an option to directly take 1% of 4400, or you can convert 4400 into local currency and then take 1%. Your answer will not differ. Your marks will also not differ. So whatever you are comfortable with, you can do. So here the commission would be 4400 into 1%. I have converted into INR here. You can directly also take 4400 into 1% because this is not a buying commission. This is a normal local commission and therefore this will be included in 4400. Now again we know bill of entry. Bill of entry date always relevant for rate of exchange. Therefore rate of exchange fixed here. But for basic custom duty, I will take later of arrival and bill of entry, and the later is 15 or 18. Later is 18, and therefore 10% becomes my basic custom duty. Interbanking rate they have given 106, which is irrelevant for us. We always want the CBIC rate. Interbanking rate is not at all relevant for us. Done. The question is solved here only. What else do you need? FOB value is 4400. FOB value is 4400. I convert it into INR. I know 102 is my relevant rate for conversion. So 4400 into 102. Right, I got this. Plus I know vendor inspection charges not to be included because it is not a part of contract. I got this 4488 as my local commission. They have said 1% of FOB. So FOB is 4400 and 1% of FOB to be taken as commission. And therefore plus 4488 will become my commission. And here I come to my adjusted FOB, which is 453288. So adjusted FOB is 453288. Now, this is a case of error. They have given us actual freight. Which is 500. Relevant rate of exchange is 102, which means 500 into 102. 500 into 102 is 51,000. 500 into 102 is 51,000. Or I compare it with 20% of my adjusted FOB. So 453288 is my adjusted FOB. Multiply by 20%, which gives me 90657. Now, do we understand that the actual amount is lower? And therefore we take 51,000 as adjusted FOB. Due to this, the answer matches with module. Otherwise, what module people have done, they've taken this commission after FOB. Now understand, if in any case FOB value would have been higher, this 20% would have been higher, and then your 20% would not match with the amount that they have taken. Here, coincidentally, the answer is matching because actual amount is lower, 51,000. Insurance, since they have given actual insurance, 600. So I directly take 102 into 600, which comes to 61,200. Add everything and you arrive at the assessable value, CIF value under customs. Now rate of duty is 10% and integrated tax. They have given IGST at what rate? They have not given us IGST rate, I feel so. They have not given us IGST rate. So if they have not given us, we can also not take. So simply you take 10% as basic custom duty and 10% of this as social welfare surcharge. And total of this is your customs duty payable. Since they have not given us IGST rate, we cannot do anything. We cannot, based on our understanding, take any GST rate. So the question becomes more simple because no GST given. So you directly take basic custom duty and plus social welfare surcharge. Tell me, is this fine or not? This kind of questions actually do appear in examination. These are kind of questions that you're going to see. So do not worry if you're able to solve all of these along with the every single note that you have to write. That why you include a commission, why you do not include a commission, why you take this particular date, why you take this particular rate. Every single thing you have to write in your notes to the answer. So tell me everyone with me. Everyone with me, you are getting answers on your calculators, yes or no? Yes, ma'am. Done. Let's move forward. F Limited imported a machine from UK in May. The details in this regard are given as under. FOB value. Again, they have given us FOB value as 10,000 UK pound. Air freight it is. Air freight it is means I will have to compare it with 20%. License fee, the buyer was required to pay in UK. Any royalty, any license fee that buyer is required to pay will be added. So, for my adjusted FOB, I will take 10,000. I will also take this 400. Buying commission is never to be included. And therefore this is irrelevant to me. Now this is rate of exchange and IGST and insurance were not available. Okay. So first of all, my adjusted FOB. Adjusted FOB would be 10,000 plus 400. So 10,400 is my adjusted FOB. Understood. Now I know that the bill of entry is 20 May. So whatever is the CBIC rate on bill of entry will become relevant. So 99 per pound. For rate of customs, for rate of duty, I will see later. So arrival is on 25th May, bill of entry is 20th May. Whichever is later. Later is 25th May. Therefore 10% will be the basic custom duty rate. So FOB value is 10,400. I multiply it with 95 and or you can just directly first of all compare the freight and insurance. So see, freight they've given us 3,000 pounds. Actually is 3,000. Now 10,400. 10,400 multiplied by 20%. gives you 2080. So 10,400 multiplied by 20% is 2080. Compare it with 3,000, lower is 2080. Therefore, freight will be 2080. Plus insurance, I have to take 10,400 multiplied by 1.125 percentage. So insurance come to 117. Right? So 10,400 multiplied by 1.125 percentage, which is 117 plus 2080 and plus I do 10,400. So my CIF value is 12597. 12597. Out of this I understand that my rate of exchange is 99. So multiply by 99 and I arrive at the accessible value, which is 1247103. Everyone got 1247103 on calculators. Yes, ma'am. They have converted here only in rupees, but I converted here, which was simpler for me because I could quickly compare 2080 with 3000. Otherwise, I would have to first convert 3000 into rupee and then compare. So always try to convert at the latest possible so that your calculation becomes simpler. They have converted here itself in INR and then they converted everything into rupee to compare. For me, it was simpler because I directly took 2080 and 3000. I compared it. I took 117 for insurance. Also, the amounts are small because dollar, pounds, euros are all costlier compared to rupees. So the amounts with which you are working would be small, making it simpler for you to calculate. And at last, I multiplied everything and I arrived at 1247103, which is accessible value. After that, 10% basic custom duty, 10% of basic custom duty social welfare surcharge, add everything, add IGST, and total of all of this will be the total duties payable. The main thing was to arrive at CIF. After that, everything we know. With me, everyone, yes or no? Again, there was nothing new in this particular question, a kind of question that we have already done. You can consider it as C category only. Done. Question 16 is purely theory, which you can self-read. Explain, but they're just asking you about the meanings of the same. Question 17. Whether the accessible value of the warehoused goods which are sold before being cleared for home consumption should be taken as the price at which the original importer has sold the goods. Now we know the price at which the imported goods are sold after warehousing them in India does not qualify as the transaction value, as I cleared already. For GST purpose, you see the one-to-one transfer value, but for customs purpose, once the goods you have put in warehouse and then even if you make one-to-one transfer, customs will be applicable on the original import value only. Because once the goods enter into India, then whatever you do with the goods, customs will be least concerned with that. Right. Now explain when the cost and services are given in Rule 10 of the customs valuation are to be added to the value of identical goods. So if the value of identical goods does not include certain specific costs, you separately add them. There's nothing new. Again, pure theory question. Examine the validity of the following statements with reference to Customs Act, whether it is valid or invalid. Chalo. So service charges paid to channelizing agent are not included. They are saying that channelizing agent cost you do not include, you always include. So this statement is not valid. As I said, other than buying commission, every single commission you are going to include. Every single commission, be it in any name, exporters commission, local commission, channelizing commission, whatever XYZ commission it is, if it is not a buying commission, you are always going to add it. And therefore, the statement that says that channelizing agent commission is not included is not valid. We are going to include it. Charges for vendor inspection on second-hand goods carried out by the supplier on his own are not included. Yes, just now we did a question where there were vendor inspection charges which the vendor included on his own. The vendor incurred those charges on his own. We did not tell him to incur those charges as per our contract, and therefore the statement is valid. That any of such charge that vendor incurs on his own, that we are going to not include. Understood. Now, an importer entered into a contract for supply of crude sunflower seed oil at $435 CIF per metric ton. Under the contract, consignment was to be shipped in the month of July. Period was extended by mutual agreement and the goods were shipped on 5th August at old prices. Now, meanwhile, the price increased. Now, department would be asking at the increased prices the duty. Is it correct? The answer is no. I already said, even if the consignment is delayed, and at the time of importation, what we are paying was the original price that we agreed, and therefore the contention of department to ask for more duties would not be valid, because we will be sticking to our contract value that we are actually going to pay. Done. Next question. BIC and Company Limited has imported a machine from UK. From the following particulars furnished by it arrive at the assessable value and for the purpose of duties. Okay. So they are not asking us for duty, are they? No, they are only asking for assessable value. Means you are not required to calculate duty, you are only required to calculate the assessable value for customs purpose. Price of the machine, okay. Air freight. Now again, air freight means I will have to compare my actual freight with my 20% of adjusted FOB. Engineering designing charges paid in UK. Had it been paid in India, we would not have included it. But since they are paid in UK, I will include it. So my FOB would be 10,000 plus 500. License fees relating to imported goods payable by the buyer as a condition of sale. Now they are saying that license fees 20% of price of machine condition of sale. Now anything which is condition of sale, we include it as per 10.1. But include 20% of price of machine. Therefore 20% of 10,000, which is 2,000. So 20% of 10,000, which is 2,000. So 1,000 plus engineering cost, which is 500, plus 2,000, which is 20% of 10,000 I'm going to include. Then materials and components supplied in UK buyer free of cost are 20,000 rupees. Okay. Now we know that any material, any assistance provided by buyer to the supplier will be added in the value. But everything till now is going in pounds. This material component supplied by the buyer, they have given in rupees, and therefore here itself, first of all, I will have to convert everything into rupees and then add this 20,000 in rupee terms. Understood? For that I need my rate of conversion. Again, they've given buying commission, which will not be irrelevant. So any buying commission which will not be relevant. So any buying commission is never relevant. Interbanking rate of exchange, again not relevant. Now, CBIC has notified for purpose of section 14 exchange rate of 100. CBIC rate will be relevant for us. Yes, therefore 100 will become a relevant rate for us. Importer paid 5,000 rupees towards demurrage charges for delay in clearing the machine. See, ship demurrage charge you are going to include in transportation. Air demurrage charge you are not going to include. I specifically mentioned this. Now here they are saying that the demurrage charges is paid, but the transportation is done by air. Had this been ship, ship demurrage charges we include as a part of transportation cost, but air demurrage charges we are not going to include. Do you now understand everything? I have written every single thing in the format that I have taught you in the theory, but you will actually start applying, you will actually start understanding once you do one or two questions with respect to that. So here this question has given you air demurrage charges. So now you understand that this 5,000 will be irrelevant. Why? Because it is air demurrage and not ship demurrage. Understood? We for now wanted rate of exchange, which is 100. So therefore 10,000 which is my FOB value, plus my price of machine, plus I do 500 as engineering charges, and plus 2,000 as my commission, which gives me 12,500. Multiply by 100 I will do to convert everything into rupee. So multiply by 100 I did. Plus 20,000 rupees they have given me for material. So plus 20,000 rupees I do, which gives me 1270. So which is 12,70,000. 12,70,000 is my adjusted FOB. 12,70,000 is my adjusted FOB. Now, insurance they have given us directly 6,000 rupees, which is fine. For freight I need to compare. So 12,70,000 into 20% gives me 245,000. This is 20% freight. But the actual freight is 3,000 pounds. Now 3,000 pounds and relevant rate is 100. Therefore, it would be 3 lakh, whichever is lower. Lower is 245, lower is 254, sorry, not 245, yes, 254,000. Therefore, 2,54,000. 2,54,000 is the freight. I have also given working notes here that FOB into 20% or actual freight into converted into INR, because now everything is going in INR. So lower will be 2,54,000. Very good, Shipra. So lower would be 2,54,000. and plus I have insurance here in INR 6,000, which they have given me actual. Had they been not given this 6,000, I would have taken 1.125% of adjusted FOB, and here I arrive at assessable value. And this is the end of answer. Why? Because in question they have only asked me assessable value and they have not asked me to calculate the customs duty. Done. You can consider this as a B category question to understand at what point of time to convert dollar, pound, whatever they've given into INR for better clarity and understanding. Done. Question 22. Briefly explain. It's a pure theory question asking that what date you have to take for rate of duty, bill of entry or arrival, whichever is later. Simple theory. Again, theory you can just self-read. See, these are these cases when your declared value can be put under doubt, when there is significantly higher value, sale, abnormal discount, as it is theory we have studied in the notes. Next question. Jagat Corporation Limited imported some goods from US. The details of transaction are as followed. CBIC rate, RBI rate. What is relevant for us? CBIC rate. Therefore, RBI rate becomes irrelevant. Now, CIF value of goods is $1,50,000. They have directly given a CIF value and there is no adjustment with respect to freight or anything. Means I can say this is a question of types of duty as such. Directly CIF value is given. I just convert it into rupee by applying the rate of 70 and then I just simply have to calculate my basic custom duty, SWS on BCD, add everything and charge IGST on the same. So C category types of duty question, it is nothing to be done. Understood. Question 25. ABC Industries imports an equipment by air. Again it is air, means original freight will be required to be compared with 20% of FOB. CIF price of the equipment is 6,000. They have given us CIF. We need to start our question with FOB. So CIF price is 6,000. Freight paid is 1,200. So to arrive at FOB, I will have to reduce 1,200 from this CIF value. Insurance also 1,800. So 6,000 minus 1,200 minus 1,800, 3,000 becomes my FOB value. 3,000 becomes my FOB value. Banker realizes the payment. Is bank realization rate relevant for us? The answer is no. CBIC rate relevant for us? Yes. Therefore, interbanking rate irrelevant, but conversion rate of 70, which is CBIC rate, will become relevant. Now, rate of exchange by RBI. See, they've given us 3 rates: RBI rate, interbank rate, and CBIC rate. We have to take CBIC rate, which is 70. Interbank irrelevant, RBI also irrelevant. We expend 56,000 in India for development activities with respect to imported equipment. Will this be added? No. Once you import certain thing, then you can do whatever expense you want on that imported material. Then it is not a condition of sale. See, it is not a condition of sale. Today, if I import this bottle, now after importing, I want to write my name on this bottle. I want to get this bottle painted. Everything is after importation, not a condition of sale. Therefore, it will not be added in the import values. So this 56,000 will also be irrelevant. Basic custom duty, IGST, and social welfare surcharge. Understood. So first of all, from CIF value, I reduced freight and insurance. I arrived at 3,000 FOB. This is a case of air, and therefore 3,000 multiplied by 20%. So I take 3,000 multiplied by 20%, which is obviously 600. Compare it with actual freight, which is 1,200. Lower will be 600, and therefore my FOB value 3,000 plus 600 freight I do. Insurance, they've given us actual 1,800. So I take actual 1,800 insurance. I arrive at CIF value in dollars. Relevant rate of exchange is 70 for me. Multiply it with 70 and I get assessable value in INR. After that, you can do on your own. After that, you just have to take basic custom duty, social welfare surcharge, IGST, and add everything. Yes or no, everyone. Extremely simple question. What was important in this question was to identify the rate of exchange, because they've given you 3 rates: 61, 70 and 72. The question basically is to identify rate of exchange, because every other thing is extremely simple. By now you know that whenever it is a question of air, we will compare 20% of adjusted FOB with actual freight to arrive at the freight amount. So you need to know that the CBIC rate of exchange will be relevant and not interbanking or RBI rate. C category question you can consider. Done. Then question 26. Compute the total custom duty and integrated tax payable under customs law on imported machine. Now assessable value as well as tax, both you have to calculate. Cost of machine at the factory of exporter. Yes, it will form a part of FOB. Transport charges from exporter's factory till the port of shipment. So this is exporter's factory, this is port of shipment. So whatever charges incurred till here will also be a part of CIF. Handling charges paid for loading the machine in the ship. Again, incurred at exporter's port, therefore this will also form part of FOB value. Freight charges from exporting country to India. Now they've given us freight charges and this is done at shipment because it is shipment and they've given us actual freight. Therefore, there is no need to take 20% of FOB. Why? Because in case of a vessel, if actual freight is given, we take actual freight only. Understood. So here, buying commission becomes again irrelevant. Lighterage charges paid at the port of importation. Now this is a case of ship demurrage. So ship ke case mein, in ship cases, all lighterage, barge, ship demurrage charges will be included. But these amounts are given in rupees and these amounts are given in dollars, and therefore we need to first of all convert everything into rupee and then add things in INR. And freight incurred from port of entry to inland container depot. Once the goods have reached Indian ports. Now from here, if you transfer the goods into an inland container depot, that obviously you are not going to include in your valuation. So CIF value is only till your goods reach the port of importation. So freight incurred from port of entry to inland container depot will become irrelevant. Right. Bill of entry, always rate of exchange will be of bill of entry, which is 70 rupees. But for rate of customs duty, we will see later of bill of entry and entry inward, and later is 25th March. Therefore, basic custom duty of 10% will be applicable. IGST, they have given us 12%. Question is again extremely simple. See, first of all, we need to calculate FOB value, right? So, cost of machine, transport and handling, which is 20,000 plus 800 plus 50, which is 20,850. So, $20,850 it is. I will multiply it by relevant rate of exchange, which is 70. So multiply by 70 gives me INR 1459500. Right? 20,850 and multiplying it with 70 rupees, I get 1459500. To that, I need to arrive now at the adjusted FOB. I have freight, but I will add it after adjusted FOB. To arrive at adjusted FOB, I need to add all other charges, but there are no other adjustments as such. Because freight, lighterage and ship demurrage, everything will be a part of freight only. So freight charges, lighterage and ship demurrage is kind of a freight charge only if we consider, right? So here I converted it into INR. Now the freight amount they've given in dollars, which is $5,000. So 5,000 multiply by 70, which gives me 3,50,000. So first of all, this is only our FOB. This is only our FOB value because there is no other adjustment required to be made. Now I need to add total freight. Now freight is made up of three things here: freight, lighterage charge and ship demurrage. Everything as such is a part of freight only. So my total freight would be 5,000 into 70, which is 3,50,000, plus I will do 12,000 rupees and plus 24,000 rupees, which gives me 3,86,000. Now you can add separately also and you can add together also. So 350 plus 12 plus 24 is my total freight expenses. Now because they have given us actual, we will take actual. Had they not given us actual charges, we would have taken 20% of FOB directly in place of total of all of these three. Now they have not given us insurance in the question. So we know insurance will be 1.125% of FOB. Now FOB is 1459500. Therefore 1459500 multiply by 1.125%, which gives you the insurance charge, which is 16419. Now after adding insurance, you've arrived at CIF value. Then everything is simple. You come to CIF value, basic custom duty 10%, social welfare surcharge 10% of this, and IGST 12%, and you arrive at the total customs duties that you are required to pay. Say everyone yes or no. Chalo quickly. Few more questions to go, everyone. Stay with me. I can see number of students getting lesser and lesser as we are moving towards more questions. But ultimately, this is One time if you practice all of the questions together, all the concepts will be consolidated in your mind. So by now you know, I need to take all commissions, I need not take buying commission. I need to take ship demurrage, I need not take air demurrage. If you leave the session in between, you will not be able to connect everything. So make sure you stay till end so that we complete everything in one go. And next time when you want to revise valuation, you want to solve all the questions, you do not require more than 1.5 to maximum 2 hours. And this is how you are going to finish off everything one day before your examination. So make sure to stay till end, no matter how much painstaking it becomes. I am also here solving each and every question with you. I could have given simple questions for homework, right? We saw a lot of repetition, but I personally wanted to solve all the questions here only so that you need not feel lazy to solve those questions later. So I can give homework, but I'm not giving. So stay with me. Sure. This is again a pure theory question, which you can see they've not given Kaveri a particular opportunity to explain Kaveri. So simply the department should give reasonable opportunity to establish that import transactions were not comparable. Otherwise, you can just self-read that whatever Kaveri has done is correct only. Okay. Again, this is a pure theory question where they've given you a warehouse ka case. So they've given you into bond bill of entry and ex bond bill of entry. They've given rate of duty and rate of exchange for both. I have simply put the extract of the table here that we've studied, that 1st August, which is ex bond bill of entry date, the rate of duty applicable will be relevant for us, and 5th June, which is into bond bill of entry date. So whatever is the CBIC rate on this particular date will become applicable. So it is very much simple that when you filed into bond bill of entry, the rate of duty was 50%. But when you filed ex bond bill of entry, the rate of duty became 30%. What is relevant? What is relevant for us? Which is 30%, which is the ex bond bill of entry. So it is pure theory question where you just have to play with the dates and the rates. Again, difference between deductive value and computed value. One is rule 7, one is rule 8. One starts from resale value, we keep reducing things and come at CIF value. Whereas in computed value, we think as if we are the exporter. Starting from there we keep on adding all the values. So these kind of questions, least possibility to come in exam. Again theory. Come to question number 34. Extremely important A category chapter where A category questions where majority students are having issues. The concept is kind of weird to digest. So mark it as A category question number 34. Product Z was imported by Mr. X by air. Okay, so first of all, it is the case of air where I need to compare my actual freight with 20% of my adjusted FOB. Details of import transactions are given. Okay, so price of Z at exporter's factory is 8500. Freight from factory to load airport 250. Handling and loading charges at load airport 250. Okay, then freight from local airport. This I will compare, and insurance charges they have given. So first of all, I need to come to FOB. For FOB, I know price at the factory plus factory to port plus port to aircraft. These three will become my FOB price. So 8500 plus 250 plus 250 is 9000. So 9000 is my FOB. Now I will take 20% of 9000. 20% of 9000. Which comes to 1800, and the actual freight, see 20% of 9000 comes to 1800. What is the actual freight? 4500 plus, see now here directly 4500 is also higher than 1800, so we take 1800. But what is the catch here? Understand. Full attention. First of all, when we have to calculate 20%, we calculate 20% of the original FOB. What is original FOB as per us? We will take price at the factory plus any transportation done from factory to port or airport plus any other amount incurred to load the goods into vessel or ship or aircraft, because that is what we understand as FOB price. I will calculate that FOB price. I will take 20% of this FOB price, which is 1800. I will compare 1800 with what is the question? 4500? No. Now we will think. Now we will think that right from exporter's factory till port of importation. I am repeating once again. Right from exporter's factory till port of importation, what are the transportation charges being incurred? So essentially this 250 and this 250 are also a part of transportation only, right from exporter's factory till the port of importation. So I will compare my 1800 with 250 plus 250 plus 4500. Now here we directly know that 1800 is a lower amount. Therefore, when you now calculate your CIF value, we will take 1800 and plus we are going to add. So here 8500 is my ex factory price. I will directly add my freight of 1800 to this 8500 and not to 9000. See, first of all, to calculate 20%, of my FOB, I will calculate my actual FOB. I will take 20%. But now when I compare this 20%, I will compare it with all of the freights amount that are there. So even if there is a transportation, loading, unloading charge, everything I will include. And now my assumption is that this 1800 includes everything. So our assumption says that the 20% amount that we take, the 20% lower amount that we take includes all of the transportation charges right from exporter's factory till the port of importation. So the only catch here is, first of all, you calculate your FOB value very much normally. You calculate your FOB value very much normally that you do. One second. So you calculate the FOB value normally as we do in all questions. But in case of air, actual freight shall include all the expenses relating to freight right from the exporter's factory. Hence, if 20% FOB is lower than the actual amount, it is deemed to include all such expenses from the exporter's factory till the port of importation. Right from exporter's factory till the port of importation, everything is included in this 20% is what we are going to assume. So first of all, when you need to calculate 20%, you will calculate actual FOB 9000. Take 20% of this only. Once you get the 20% amount, then you think everything as freight only. So now 1800 is my lower. 1800 is lower as my freight. So I will start the question saying that 8500 is my ex factory price. Now every other thing that I added, I have done it in inner column only, not added in my CIF value. So directly 8500 plus I will do 1800 freight, insurance actual they have given. Now I arrive at CIF value. Now nothing is required to be done. You know what is the rate of exchange and you can directly calculate what are the taxes applicable. The only and only catch is working note for freight, which says I will see 20% of FOB, but I will compare it with the total transportation expenses. Now understand, in this particular question, if this was not 4500 but this was 450, if this freight was not 4500 but it was 450, then my actual freight would be 250 plus 250 500 plus 450, which is 950. So here my actual freight would be 950. Now I compare 1800 with 950. What is lower? 950. Now in this case I will take everything, 250, 250, 450, everything. But once if my 20% amount is lower, if this amount is lower, then deem it is included that from exporter's factory till port of importation, everything forms part of this 20% only. There is one more question like this so that you will get more clarity, but quickly tell me you've understood. These last 3-4 questions are extremely important. Question 34 till 37. Other than that, everything was extremely simple. We saw 34 we did, 35, 36, 37 are important questions. Yes, we've understood. A category. Done. Now question number 35. An importer from Cochin imports goods from an exporter in US. The vessel carrying the goods reaches Mumbai port first, and from there goods are transshipped to Cochin port. Determine the assessable value. Okay. Cost of machine at the factory of exporter, yes, we are going to take. Transport charges, yes. Handling charges, yes. Buying commission, never relevant. Freight from exporting country to India. See, first of all, we know to calculate FOB, we are going to take all of this. Once we get 20%, then all of this will be added along with this normal freight, just like the question we did now. So because it is a case of air, no, it is a case of shipment only, not a case of air, it's a case of shipment only. Okay, so for shipment, see, understand. This question that we did was with respect to air. This question was with respect to air. Therefore, it was mandatory for us to compare air freight with 20%. Hence, we did all of this. But in this particular question, it is shipment. In this particular question, it is shipment, and they have given us actual freight. Therefore, there is no need to compare anything with 20%. So, all of the actual amounts I am going to take. Understood. Actual insurance charges are not ascertainable. No problem. We know we are going to take 1.125% of adjusted FOB. Now, charges for design and developing incurred in US will form part of adjusted FOB. Loading, unloading at the place of importation. At the place of importation, loading, unloading is not included. At the place of exportation, loading, unloading is included. Therefore, this becomes irrelevant. Also, any of the transshipment charges are never part of assessable value. Now, exchange rate, they are saying 70 rupees to be taken. Done. What will be my FOB value? 20,000 plus 1,000 plus 100 plus 5,000, which is charges for design and engineering work, right? So 20,000 plus 1,000 plus 100 and plus designing charges. So 26100 is my adjusted FOB. Because this is the case of ship and I am given with actual freight, I will not do anything, no 20%, nothing to be done. Directly freight of 2,000 I will add. Insurance I do not have. No problem. My FOB, adjusted FOB is 26100 multiplied by 1.125%, which gives me 293.625 as my freight, as my insurance. Adding everything, multiply by 70 and I arrive at my assessable value. See, same category, same kind of question 34 and 35 are. The only difference is 34 is with respect to air. Therefore, I had to compare my freight with 20%, which made the question complex. But 35 says it is a case of ship, and therefore I need not compare anything with 20%. Whatever is my actual freight will be my, whatever is my actual freight will only be taken as my freight. And therefore, nothing I have to do because it is a case of ship. Therefore, 35 question becomes simple, even though the data is similar to what is in question number 34. Right. Now, question 36. ABC Industries Limited of Mumbai imported one machine through vessel. Now again it is vessel from Japan in the month of November. Cost up to the port of exportation 6 lakh yen. Loading charges at the port of exportation will form part of FOB. Freight charges from port of export till India. Again they have given us actual freight and it is a case of vessel. Vessel actual freight is given. It will become relevant for us. Additional amounts they have said. Designing charges incurred in New Delhi. Any of the engineering, designing, development, sketch charges incurred in India are not required to be taken. So your designing charges are incurred in Delhi, which is India. Therefore, this will become irrelevant. Commission paid, but not buying commission. Yes, this will be included. So any commission paid, now all of this in rupee and this is in yen. So we understand we will quickly have to convert everything into rupee so that calculation becomes simple. Understood. So this will be included. Actual lending charges paid at the place of importation. Any lending charges, unloading charges, port charges at the port of importation are never included because the ship has reached India. After that you do whatever will not form part of CIF. Actual insurance charges not ascertainable, no problem, 1.125% we can take. Lighterage charges they have given. Again this is a case of vessel, right? This is a case of vessel and they have given lighterage charges, means this will be included. Understood. Basic custom duty directly given, social welfare surcharge, IGST and rate of exchange to be taken as 0.71. So 1 yen is equal to 0.71 rupees. Understood. So FOB value would be 6 lakh plus 25,000, right? 6 lakh is the cost till the port of exportation plus loading charges 25,000 yen. Now the remaining data is in rupee. Therefore, I will quickly have to convert this into rupee. Rate of exchange is 0.71. So I add 6 lakh plus 25,000, multiply it by 0.71. Plus I will have to add plus I will have to add this commission paid because this is not a buying commission. So 1,25,000 commission I add. This is my adjusted FOB. So 5,68,750 is my adjusted FOB. Now, since this is a question of vessel and they have given me actual freight, I will not do any horse sharing. I will directly take my actual freight, which is 1 lakh. But 1 lakh yen it is. I have converted everything into rupee. Therefore, 1 lakh into 0.71. This is my freight amount. I don't have actual insurance amount given with me in the question. No problem. I have adjusted FOB. Take 1.125% of this as your insurance. Add everything and plus 20,000 by added separately. 20,000 is my lighterage charge. Now I know for ship lighterage is also a part of freight only. So ideally what I should have done is 1 lakh into 0.71 plus 20,000 I should have added here only, and this is my total freight. But since it is a case of vessel, everything is taken on actual value, so adding it here or here will not make a difference. So adjusted FOB plus my lighterage charges, transportation charges, insurance charges, and this is my assessable value. After you arrive at assessable value, everything is extremely simple. Basic custom duty, social welfare surcharge and IGST. Tell me yes or no. So we've understood lighterage, barge, ship demurrage charges to be included always, and also ship demurrage charges. If you are taking 20%, if 20% amount is lower, then you need not add ship demurrage again, because we will deem assume that now everything forms part of that 20% only. But when everything is given to you on actual basis, you keep adding everything on actual basis. At that point of time, we will add everything separately only. Understood? Got the answer, everyone? Yes, ma'am. Last question of customs valuation. We have overshoot our time by, I guess, 40 minutes. But it is okay because I think we have done every single question with extreme clarity. Chalo. Come to last question, question 37. Mark it as A plus category of question. Extremely important. If you get this question right at first time, means you've understood entire valuation chapter extremely clearly. Mr. X imported certain goods from a related person, Mr. Q of US, and transaction value has been rejected. 4 and 5 of import valuation are found inapplicable, and therefore we have been furnished with the data. Now we need to calculate assessable value as per the applicable rules. Okay, so this is a case of computed value, right? We start right from the cost of materials being used by Mr. Q. From there we are starting the answer. So okay, so first of all we need to come at FOB value. For FOB value, cost of material 2,000, fabrication charges 1,000, other charges 400, other indirect cost 250, freight from factory to port, that is also a part of FOB value only. So freight from factory to port 250, loading charge at US port, again 100 we are going to add, and net profit is 20% of FOB they are saying. Means 20% of FOB means 25% of cost. This is our total cost. And they are saying the profit margin is 20% of FOB, not of cost. Means if FOB is 100, 20 is my profit and cost is 80. Now this is 4,000. So if 80 is 4,000, what will be 20? What will be my profit amount? So we get 1,000 as profit. So I add 1,000 rupees in 4,000 and I arrive at 5,000. 5,000 is my FOB value. Sure. Tell me, understood? How did we come at 5,000 rupees? I added all of my costs. And they are saying profit is 20% of selling price. We understand 20% of selling price is 25% of cost price. So they are saying that of FOB 20% is my profit margin, and therefore this 4,000, which is my total cost, 1,000 of this 4,000, 25% of 4,000 would be my net profit. So adding 1,000 rupees profit gives me 5,000 as FOB. Everyone arrived at 5,000 FOB. Yes, ma'am. Chalo. Now air freight from US port to Indian port. Now everything is okay. So this is FOB that I arrived at. Now I know for freight. Since this is a case of air, I will have to compare 20% of FOB along with my actual freight. Understood. Insurance they have given, exchange rate they have given. So simply to take 20% of FOB, FOB is 5,000. FOB is 5,000. So 5,000 into 20% gives me 1,000 rupees, which is my freight. But now when I compare it with actual, I know when I compare it with actual, I will have to take all of the transportation charges right from the port of exportation. So here, this freight from factory to US port 250 plus loading charges at US port 100 and plus the actual air freight 1500. So I will have to compare this 1,000. I will have to compare this 1,000 with 250 plus 100, which is 350 plus 1500, which gives me 1850. Similar to question number 34. That first of all, to take 20%, I calculate actual FOB. But now while comparing the freight, what I will do is take all of the transportation expenses all together, right from exporter's factory till the port of importation, which is this plus this plus this, which comes to 1850. Whichever is lower is 1,000 rupees. Therefore, the freight would be 1,000 rupees. Now, will I add 1,000 rupees in 5,000 or I add 1,000 rupees in some another amount? Chalo, tell me. Should I add? I understood that the freight is 1,000 rupees because lower of 1,000 plus 1800. Should I be adding 1,000 directly in 500 because that is my FOB, or I need to add this 1,000 in some another amount? I need to add this 1,000 in another amount. Why? Because now this 250 plus 100, I will be deemed assuming is included in my 1,000 freight only. So first of all, just to calculate this FOB, I added everything. But now at the time of my final CIF calculation, I understood that my freight is 1,000, which is 20% lower than the actual. Therefore, this 20% will be deemed assumed to be including 250 and 100. I will not include it again. So I take 2,000 plus 1,000 plus 400. 2,000 plus 1,000 plus 400 plus this other indirect cost 250 plus my 1,000 rupees profit, and this is my FOB now. Plus my 1,000 rupees profit. I will not take 250 or 100. Why? Because I will be deemed assuming that this 250 and 100 is a part of 1,000 rupees freight, and therefore I will not include it again. Plus insurance 50, they have given us actual. Make a total, multiply it by 70 and you arrive at the rupee assessable value. Quickly tell me yes or no. So question 34, 35 and 37. Three extremely important A category questions. The idea is very much simple. In case of vessel, you take everything actual. In case of air, you compare actual with 20%. While comparing, you calculate FOB normally as we do. The real FOB value into 20%, you get an amount. But when you compare it with actual, do not just take the freight. Take all of the other amounts after exporter's factory till the port of exportation. Yes, understood. And once we compare, if the 20% amount is lower, then we will assume that all of those expenses are included in this 20% as we assumed here. And we then ignored 250 plus 100 finally at the time of final calculation. Here in this question, they have given us insurance. Had they not given us insurance, we would have taken 1.125% of 5,000 only. We have taken 20% of 5,000 only. But while adding, we do not take 5,000. We take 5,000 minus 250 minus 100 as our FOB. Yes, everyone understood. So these are all the questions. There are a lot of other questions given in the question bank which you can self-do. Till 37, I've made sure to take all ICI illustrations and test knowledge questions, which as such include all the categories and types of question. Now, all the new questions that you're going to encounter would be a combination of one or two of these questions only. Somewhere they'll be giving you multiple rate of exchange. Somewhere they will be giving you multiple dates or the commission adjustment or the demurrage adjustment. Everything can come together also to make the question complex. So more or less it is this only. You can just find different types of adjustments given differently, but the treatment would be same as here we have done only. So 3 hours non-stop, and we have completed entire theory as well as questions of the valuation chapter. Done. I can give you a 2 to 3 minutes break if you want 5 minutes also, and then we shall complete warehousing as well as duty drawback also. Both of them are very much small, simple chapters. 1 hour more and 1 hour we'll complete duty drawback as well as warehousing together only. So stay with me, do not go. If you want, we can take a 10-15 minutes long break also. You want to go have lunch, then go have lunch and then we can start. And you say in the chat box, you want a 15 minutes break or you want me to take a 3-4 minutes break and just complete the pending topic, because we are going to do that in this video only. Shall tell me, you want a bigger break to go have lunch because it's lunchtime? Okay, we can resume in 15 minutes. I have no issue. We will resume in 15 minutes. Okay. So it is 11:37 right now. I guess 11:55 we can resume. You can just go have lunch and we can start by 12 around. Okay, so welcome back everyone. Shall we start? So shall we now start with warehousing? Again, an important chapter for customs. Many times you can find a 5 marker or 4 marker question from this, or in fact for MCQs we can say. Sure. Everyone is back, so let's start with warehousing. Very much simple chapter again it is, and more or less the things that we study in warehousing we kind of know. Why? Because we have certain portion with respect to bond to bond transfer in GST. We also have provisions with respect to warehousing in the importation exportation chapter, levy chapter. So by now you know that we have this option that when we import the goods we can either clear them for home consumption directly, or else we can deposit those goods into customs warehouse by filing into bond bill of entry, and after that whenever we want to pay taxes we can file ex bond bill of entry and clear our goods. So this is the basic structure that we know. Now what are the types of warehousing? For what period you can deposit your goods into warehousing? What period is allowed you interest free? If you exceed that period, then what interest you are required to pay? All of this calculation is what we are going to study in the chapter of warehousing. So warehousing facility facilitates storing of imported goods without payment of customs duty. So we already know that you can deposit your goods into warehouse without paying any customs duty, and ultimately when you clear your goods, at that point of time you're required to pay customs duties. This facility is also useful when imported consignment is to be shipped out of India. Why? Because when we import certain goods, we pay duties on those particular goods. We use them for manufacture, or even without manufacturing we directly re-export those goods to some another country. So now in that case government gives us duty drawback. So whatever taxes I've paid on importation, government gives me back those taxes if I export those particular goods. So government here says, why to do all of this hassle, that first of all you import the goods, you clear the goods for home consumption, then you export the goods, then we give us the duty back. What we can simply do is you import the goods, put them in customs warehouse without paying any duty, and directly from there only you export your goods. So no duty paid, no question of refund or drawback arises. So this facility is also useful when imported consignment is to be shipped out of the country, because there would be no point first collecting the duties and then granting drawback on the same duty. So you just import, don't pay taxes, put them in warehouse, and from warehouse only you can directly export your goods. What consideration you're required to pay? So we know you need to bind yourself with a bond amount. You have to bind yourself with a bond and a security. So he should bind himself to pay to government a sum equal to thrice the amount of the total duty determined with a surety or security. And also you have to agree to pay. The duty whenever those goods are cleared at whatever rate is prevalent there. So we saw that in case of warehousing, what is the rate of duty? In case of warehousing, whenever we find, ma'am, please don't take her name, I can't help. It is ex bond bill of entry. So whenever I file my ex bond bill of entry, whatever will be the rate of customs duty applicable on that particular date will become relevant. Understood. So how the mechanism works is, I import certain goods, I file an into bond bill of entry to get my goods warehoused, I execute a bond to cover the risk of customs duty interest, and also in addition to bond, I also may be required to furnish certain security. Now whenever I want to clear those goods from this warehouse, I will be filing ex bond bill of entry and paying all of the applicable duties. Now you might have a question that why thrice? Why thrice amount I have to pay to deposit my goods into warehouse? It is very much simple. The total amount payable by you can extend to the duty that you are required to pay plus interest, and also 100% penalty in certain cases can also be applicable. So on a safer side, that government thinks if you exceed all of these things, means you are required to pay entire duty, interest and the penalties, everything, the maximum amount that can be payable by you could be thrice of the duty amount. And therefore for safer side, to securitize the government payment, what government can do is, government can tell you to execute security and bond always thrice of the duty determined you have to pay. Okay. So types of warehouses, again, extremely simple. Now see, warehouse can be established at any place in India. It just has to be licensed, right? So any of the warehouse which is licensed by customs officer becomes a customs bonded warehouse. Now, public warehouse, private warehouse and special warehouse. We have three kinds of warehouses, very much simple. Public warehouse is simply a site licensed by the Principal Commissioner of Customs or the Commissioner of Customs, and any person who is an importer can store the dutiable goods here. You can find these notes and question bank from Telegram channel. Also, I provided the link in the description of the video. Okay, so public warehouse, any person can deposit goods. But private warehouse, as the name suggests, are private. So private warehouses, as the name suggests, are private, means only the licensee of that particular warehouse can store the goods in a private warehouse. So here dutiable goods imported by licensee are deposited, and here any importer can deposit goods in a public warehouse. Special warehouses are again licensed by customs commissioner only, but certain notified goods which can be precious goods like diamonds, gold, silver, ornaments, etc., kind of precious goods are kept in special warehouses. Why so? Because special warehouses are under physical lock of customs, means the physical customs lock is being put on this special warehouse where expensive goods, or I would say precious goods, are being stored. But here the public and the private warehouse are just under a normal record based customs lock, not like a physical proper customs lock. These are record based controls, but here we have a proper customs physical lock being put at a special warehouse. Now once you take a license for warehouse, it will be valid. Unless you do certain contravention, your license is going to be valid. There's no need to renew it annually. So license is not required to be renewed annually. It is not transferable. See, you cannot transfer your license to someone else. So if government gives you a warehousing license, only you can have that license. If you do not want it, you can get it cancelled, but you cannot transfer it to someone. So if any other person is wanting this license, he will have to make an application on his own only. So it will be valid till surrender or cancellation by written request of the licensee. Right. So in a public warehouse, any importer can keep goods. Any. In a private warehouse, dutiable goods imported only by licensee are deposited. And in a special warehouse, it is locked by proper officer. No person will enter, remove the goods without the permission of PO. And only notified goods like gold, silver, precious metals supplied to foreign privileged persons are deposited here. Cancellation of license. If you do any masti, department will do grand masti. So after giving opportunity of being heard, the Principal Commissioner or Commissioner of Customs may cancel the warehousing license if you contravene the provisions. But obviously they are going to give you an opportunity of being heard. Without giving you opportunity, they will not directly cancel it. And during pendency of the inquiries, your operations in the warehouse will be suspended. So say for example, officer issues you a notice to give you opportunity that why we shall not cancel your license. So during that period, when the inquiry is going on, your operations of the warehouse will be suspended. Means you will not be allowed to deposit any new goods in the warehouse. So no goods shall be deposited in the warehouse during suspension period. But whatever already deposited goods are there will continue to stay in the warehouse till suspension is going on. So already deposited goods shall continue to be governed by the warehousing provisions. Now, if license is cancelled within 7 days, if after inquiry, after giving you opportunity of being heard, department decides to cancel out your license, in that case within 7 days or plus PO can grant you extension if he thinks that it is fit to do so. So within normally 7 days of service of cancellation order plus PO can extend it. You have two options. Either you remove your goods, means you pay the duties and clear your goods for home consumption, or you shift your goods to some another warehouse. So you can remove your goods to some another warehouse, or you can clear your goods for home consumption or export, but now you cannot any further keep your goods in that particular warehouse. Right. Sure. Now section 59, which is warehousing bond. An importer executing bond binds himself. If I am executing bond, means I am binding myself that I am going to comply with all the provisions of customs law. Whatever is the specified date, on or before that date, I will pay all the duties and interest, And if any penalty arises, if I happen to contravene any of the provisions of customs law, I will be paying my penalties also. So I bind myself by doing all of this if I execute a bond. Now, bond can be a consignment bond, can be a general bond. Consignment bond, very much simple with respect to a particular consignment. Say, for example, I import 1000 bottles. Now, whatever is the value of bottle into 3, based on that, I thrice the duty of amount involved, I will execute a bond. Whereas general bond is like a running account, it's like a ledger that you can think of. That here I have certain bond amount credited. Now, whatever I import, based on that, whatever import goods I warehouse, my bond amount in this running account is debited. So whatever balance I am left with, for that balance, I can also make further imports. Now, once I pay the duties and clear my goods for home consumption, again my general bond account will be credited. So this is how it keeps going. So whenever I import certain goods, it is debited, and then ultimately my goods cleared by filing, yeah, don't take his name, please, X bond bill of entry on payment of duty. Again, my general bond is recredited. And how to decide that what should be the value of general bond? Because I could be importing goods worth any amount. How is the proper officer going to determine that this amount of general bond would be enough? That would be based on my past imports and what past duties I have paid, or the anticipated imports that I am going to do in future. So based on my past, present, future trend, they will be deciding, the additional commissioner, deputy commissioner will determine the amount of general bond that you need to maintain. And also here I have explained it to you already, that thrice the amount they've said for a consignment bond. Then why thrice? Because liability can maximum extend to duty plus 100% penalty plus fine plus interest also. So on the safer side, government tells you to execute bonds which is thrice the amount of the duty ascertainable. Understood. Above bonds valid even if goods transferred to another warehouse, which is fine. From one warehouse you transfer your goods to another warehouse, your bond will continue. But if you transfer your goods to some another person, means the goods are lying in the same warehouse or going to some another warehouse, but now they are not mine, means I am not the owner of those goods, I have made a bond to bond transfer. Now in that case, the new buyer will be required to execute a new bond and furnish security. I can get my bond free. Permission for removal of goods for deposit in warehouse. So I furnish my bond plus security, and then the proper officer will make an order permitting deposit of goods in the warehouse. So I will furnish all of the whatever documents, whatever bond security I am required to furnish, I am going to do that. And then proper officer will make an order that yes, you can now deposit your goods in the warehouse. Whereas in some cases, there is this automated system. If the automated system finds that there is no much risk involved here, without even officer getting involved, the automated system can also grant this kind of order, which is permitting me to deposit goods in the warehouse. Understood. For what period can I deposit the goods is the question. So period for which goods can remain in a warehouse. See, again, principal commissioner can extend warehousing period also. It is on principal commissioner. It can in fact reduce the period also. See, if the goods are kind of perishable or the shelf life of the goods is less, officer has a power to reduce this warehousing time also, and officer also has a power to increase this period. But the general period, if officer is not interfering, then the general period would be, if you are 100% EOU, EHTP, STP or a warehouse which are used for operations which are permitted under section 65. Means in short, you are an EOU, EHTP, STP which is keeping the goods. Maybe you are doing certain operations there, or you are not doing anything there. But ultimately you are going to export the goods from here. So in this case, they are saying whatever capital goods or whatever goods you are keeping in this warehouse, if you are 100% EOU, EHTP, STP, doing things for the things which are permitted under section 65. In this case, capital goods till you clear them from the warehouse, and other goods till you consume them or clear them. Very much simple. I can in one line say that if I am 100% EOU, EHTP, STP doing the permitted operations in my warehouse, I can keep the goods for as long as I want. Means till I ultimately clear them, consume them, use them, export them, till I do whatever is permitted, I can keep those goods in the warehouse. There is no upper time limit applicable to me. But if I am any other person, means I am not EOU, EHTP, STP, then maximum period for which I can put my goods or capital goods in the warehouse would be 1 year from the order permitting deposit. See, understand. If the officer has given me the order on 1st Jan 2024 and I actually deposit the goods on 3rd Jan 2024, after order, I took 2 days to deposit goods. That is not on department. Your time will not start from 3rd Jan. Your time is going to start from 1st January only. So this 1 year period, will automatically start as soon as the order to permit goods in warehouse is passed. So the order permitting the deposit of goods in the warehouse, from that date only 1 year is going to start, not the actual date. Question will confuse you by giving you 2 dates, saying that order was passed on this date, we actually deposited on this. What is relevant is the date on which the order is actually passed. Okay, so here I can keep my goods for 1 year, but I can keep my goods interest free only for 90 days. So here we are saying, see, understand, interest on warehouse goods. Now again, if I am 100% EOU, EHTP, STP, where my permitted operations I am carrying out or etc., anything like that, no interest is payable because there is no upper time limit also, and no duty is payable. See, understand, to pay interest, today if I pay 100 rupees taxes and 18% interest is applicable, or let's say 15% interest is applicable, that interest will be on 100 rupees. Today if I tell you no taxes are being paid, now these people do not pay any taxes only. We know that this EOU, EHTP, STP have been granted exemptions from all kinds of import duties. So when I'm not required to pay any import duty only, 0 multiplied by any percentage would always come to 0 only. So if I'm these people, no interest is required to be paid by me. But if I'm a person other than this, then in that case, if I keep my goods beyond 90 days from the date on which order permitting goods was passed, from 91st day, interest at the rate of 15% per annum is going to start till I actually pay my duty and clear my goods. So they are saying you can keep your goods till 1 year. You can keep your goods till 1 year, but only interest free till 90 days. Means no interest will be applicable on your goods if you keep your goods into warehouse only for 90 days. If you keep more than 90, it is fine because you can still keep for 1 year. But now from 91st day till the end of this year, wherever you are keeping your goods, interest will start becoming applicable at the rate of 15%. Now we know in customs, mostly at all places, interest is applicable at the rate of 15% only. What if, ma'am, I keep my goods for greater than 1 year? Your goods would be deemed to be inappropriately removed. Means if you keep your goods more than 1 year from warehouse, department will assume that you have inappropriately removed your goods and duties and everything will be applicable on you. So without paying duties, you can keep till 1 year. In that 1 year, without paying tax, without paying interest, you can keep till 90 days. The board may waive. Now always, the board means the CBIC always has the power to waive interest in individual cases. Board may also notify goods where interest shall be chargeable from date of order permitting deposit of goods in the warehouse. Now, goods which are not removed from warehouse after expiry of permitted period. So, say for example, proper officer gave you an order that you can keep your goods in warehouse for 4 months. Then you can keep your goods in warehouse for 4 months only. As soon as the 4 months expires, we will assume that the goods are deemed removed and whatever will be the rate of duty on that particular date will be applicable to you. So maximum period is normally 1 year. Proper officer can give you a specific period also. Like we permit you to keep your goods only for 3.5 months. Then you can keep your goods in warehouse only for 3.5 months without payment of duty. Now, in this 3.5 months, if you are not removing your goods, we will assume that you have removed your goods and whatever will be the rate of duty applicable on this deemed removal date will become applicable. Means we will assume that you have filed your ex-bond bill of entry. Because do we understand the rate of customs duty? The rate of customs duty is to be taken on the date of ex-bond bill of entry. Now you are not filing your ex-bond bill of entry. You should have filed because department has given you only 3.5 months time. You are not filing in 3.5 months. So as soon as the 3.5 months expire, we will assume that ex-bond has to be filed and this date rate of duty will become applicable to you. We will solve one question and everything will be cleared. Also, no duty, no interest. As I taught you, see, X is an importer who is other than 100% EOU, imported some goods, deposited them into warehouse on 12th April. These goods were re-exported without payment of duty. Because since we imported goods and we re-exported them, there was no duty required to be paid by us. Now we actually exceeded the 90 days time limit. We actually exceeded. See, 12th April till 15 August is more than 90 days. Still interest will be applicable? The answer is no. Why? Because the goods have been re-exported without payment of duty. If no duty, on what amount you are going to levy interest? Because interest at the rate of 15% will be levied on the duty amount. If duty is only 0, anything multiplied by 0 will always result in 0. So no duty, no interest will be applicable. While the goods are in the warehouse, what will be the owner's rights? Very much simple. Owner can go inspect the goods, ensure that the goods are not damaged, not deteriorated. He can sort the goods into whatever gradings he wants. He can bring someone to show the goods for sale while the goods are lying in the warehouse. So the basic owner right that you can think of. I can go inspect my goods. I can go ensure that my goods are not damaged, not deteriorated. I can sort the goods. I can bring someone to show my goods for sale. Now, section 65 and 66, extremely simple sections saying that when your goods are lying in the warehouse, now again understand this thing is not permitted in a public warehouse. So section 65, 66, whatever operation we are studying can be carried out only in a private or a special bonded warehouse, not in a public warehouse. So what they are saying, if I am importing certain goods and my goods are lying in the warehouse, I have not cleared those goods. If I want to undertake any manufacturing activity in the warehouse itself, can I do so? The answer is yes, you can do so. You just have to take permission of Principal Commissioner or Commissioner of Customs. Now in this case, after manufacturing, if I directly re-export the goods from there, no duty will be payable. Say for example, I import plastic, rubber, cell, everything. Everything is lying in the warehouse. I carry out my manufacturing activity there in my private warehouse only, manufacture a calculator and I export this calculator to USA. So we know that for whatever we export, our import duties are not required to be paid. So in this case, all of the duties are fully remitted. But if I clear these goods after manufacturing, in that case, it will be a normal supply under GST and all of the duties will start to apply. So yes, you can carry out manufacturing and other operations in your warehouse, but make sure that if you export the goods from there, no duties. But if you clear the goods for home consumption after manufacturing in the warehouse, which is not allowed in public, only in private and special you can, then in that case, you will have to pay all of the duties and GST also. Now this good part of the chapter from where question can come talks about what to do about the waste. I imported certain goods, I manufactured certain goods also out of it. Now, but certain scrap or certain waste was generated. What should I do of this waste or scrap is the question. Now, two options are available, or I would say two possibilities are available. Say for example, whatever I have manufactured, I can either export it or I can clear it for home consumption. So I can either export it or I can clear it for home consumption. If I clear my manufactured goods for home consumption, there is no doubt about it that whatever I had imported, whatever is remaining in the scrap, I will have to pay duty on the same. So if whole or part of the goods are cleared for home consumption, import duty charged on the quantity of goods contained in the waste, I will have to pay my import duty on those particular things. But if I export my goods, so whatever I have manufactured, I export. Now certain scrap or waste is remaining. What to do of that scrap or waste? Government is saying if you destroy that scrap or waste, means you cannot use it further. You just destroy that scrap or waste. In that case, no duty payable. So if you export the goods that you have manufactured, in that case, import duty remitted on quantity of goods contained in the waste if such waste is destroyed. But if you do not destroy that waste, then in that case, you think as if this waste is only imported and whatever duties is required to be paid, you pay on the same. So duty has to be paid as if such waste had been imported into India. So very much simple it is. If I manufacture, see, I'll make you solve two examples and it will be extremely clear. If I import certain goods into India, I carry out some operations or manufacturing activities on those goods. If I export the goods, then whatever is the scrap remaining, if I destroy that scrap, no taxes to be payable, no duties to be payable. If I do not destroy that scrap, then think as if that scrap is only imported and pay the duty on the scrap. But if I clear the goods for home consumption, then whatever is the actual import thing in the waste, the rate of duty applicable on that original imported article will be required to be paid by me. Let's solve a question, you will get clarity. Cutlery manufactured out of imported high-speed cutting steel strips. Locally procured plastic is used for providing handles to the cutlery, knife or fork. Now in a batch process, 200 kg imported steel strips. So 200 kg imported steel strips and 100 kg plastic is used. So plastic is local and the steel strips are imported. So total raw material used is 300 kilogram. How? 200 kg of imported steel we have used and 100 kg of domestic plastic we have used. 400 knives are made out of it. So out of these 300 kg of raw material, we made 400 knives and they are cleared for home consumption. But all of these knives are cleared for home consumption. Steel strip content in the above knives is 178 kilogram. So we understand that out of 200 kg steel strip, we could only make 178 kilogram use. Therefore, 200 minus 178 gives me 22. So 22 kilogram of steel strip is lying in my scrap. Understood? The weight of plastic handles is 85. Means my total plastic used was 100 kilogram, but my final weight of the plastic in the finished goods is only 85 kg. So 100 minus 85, which means 15 plastic is lying in the scrap. The waste is in the form of shaving. The total weight of the waste is, so what is the total weight of the waste? It is 22 plus 15, 22 plus 15, which is 37 kg. The steel content of the waste is 22 kg. So import duty of customs at the rate applicable to steel strips could be collected on the waste. So on this 22 kg, of steel strip waste, we are going to collect import duty even though it is a scrap, because we have cleared everything for home consumption. See, on this 178, you have to pay duty anyways. There's no doubt about it because we are clearing the goods for home consumption. We are specifically talking about what to do of the scrap. Very much simple. Even if you are not clearing the scrap for home consumption, but the goods you are clearing for home consumption, then on this scrap of 22 also, you will be required to pay the applicable custom duties. Right. The another alternative would be that you export the entire finished goods. If you export entire finished goods, then in that particular case, you just have to destroy that goods and destroy the waste and no duty will be payable by you. So take the example, in this case, manufacturer has two options. He can destroy the waste. Then he will not be required to pay duty on the steel strip content in the waste. But if you do not destroy the waste, then you have to pay duty on the steel strip content in the waste. Remission of duty on the imported material content in the waste or refuse is allowed only when final product is exported and the waste is destroyed. If you do not export your final product, then anyways duty will be applicable. But even if you export your final product, but you do not destroy your waste, then also duty will be applicable. You need to export your product as well as you need to destroy your waste. In that case, whatever is the imported content in the waste, no duty will require to be paid on the same. Now this was very much simple example because either we kept entire in, either we cleared entire for home consumption or we exported entire out of India. What if I keep certain portion to export and certain portion to clear for home consumption? How to make proportionate calculation there? Let's see. So now let us take an example where the final products are both exported and cleared for home consumption. Okay. So here we are saying that we have imported rubber. So the only single raw material which is imported is rubber. Other than that, everything is domestically obtained. So the quantity of rubber is 1500 kg. But other than that, bead wire, tire cord wrap or chemical, mineral, oil, whatever other things we have used is 10 plus 180 plus 4 plus 16, which is 210. So 210 kg domestic goods are used and 1500 kg are the imported goods being used. See, the total weight of raw material is 1710 kg. 1710 kilograms is the total raw material that I am using. Right. I manufactured 100 tires out of it. and the weight of per tire is 16.5 kg. Therefore, my final product weighs worth 1650 kg. Now I used raw material worth 1710, but my final product only weighs for 1650. Therefore, the wastage is of 60 kg. Yes, the wastage is of 60 kg. Now out of this 60 kg, I decide to export 75 pieces, and I decide to clear my home consumption tires of 25 pieces. So total 100 pieces are manufactured. Total 100 pieces are manufactured, out of which I decide to clear for home consumption 25 pieces, and I decide to clear for export 75 pieces. Understood? Now, first of all, what is my total waste? What is my total waste? My total waste is 60 kg. Right. Now, of this waste, how much is related to export and how much is related to home consumption? So simply I can do 60 into 25 percentage, right? 60 into 25 percentage, which means 15 worth of waste. 15 worth of waste is for home consumption and 45 worth of waste is for export. First of all, we understood this, that total waste is 60 kg. Now, home consumption is to export ratio is 25 is to 75. Therefore, I apportion 60 kg into 25 is to 75, giving me 15 and 45 for home consumption as well as export. But is this 15 kg and 45 kg entirely imported item? The answer is no, because this 60 in itself contains rubber also and other things also. Now, what is the ratio here? It is 1500 is to 210. 1500 is to 210 because the total material used is 1710. So I know out of this 45, only and only 1500 is with respect to imported things and total is 1710. So if I do 45 into 1500 upon 1710, it brings me to 39.5 kg. So here I can say that out of this 60 kg waste, only 39.5 kg waste is the imported material waste, which is in relation to export. If I destroy this, if I destroy my entire waste, then in that case, I will not be required to pay any duty on this 39.5. See, even if I destroy or I do not destroy, no one can save me from paying duty here. So here 15 into 1500 upon 1710. On this 15 into 1500 upon 1710, which will come 13.2 kg. No one can save me because I have cleared the goods for home consumption. So without a doubt on this 13.2 kg, I will be any day always required to pay customs duty. The question is only for the goods which are exported. For exported goods, total waste is 45. Out of 45, imported waste is only 39.5. So they are saying that import duty leviable on import rubber can be remitted if I destroy entire 45 kg. If I destroy this entire 45 kg, then no duty will require to be paid on 39.5. Otherwise, I will have to pay duty on this also. Even if I destroy or do not destroy, on 13.2 duty is mandatorily required to be paid because it is cleared for home consumption. Chalo, tell me you understood this, everyone. So import duty is compulsorily leviable on the 13.2 kg which is being imported. So we took all three examples. 1, when entire goods cleared for home consumption. 2, when entire goods exported. 3, when part goods cleared for home consumption, part goods exported, and even in that, raw materials are certain imported and certain domestic raw materials. Understood, everyone? Is it hashtag dil dil agag bomb bomb moment for us? Yes, ma'am. So now the chapter is over here. Other everything is extremely simple. We can just self-read it once. Sure. Not skipping, I'll make you walk through it. Removal of goods from warehouse. What you can do, either you can transfer your goods to another warehouse. Simple, you just need a permission of proper officer and a proper dispatch of goods under one-time lock and proper receipt of goods at the destination. There has to be no risk of revenue. So when the goods are being removed from one warehouse, being taken to another warehouse, officer will look into it and it will be under one-time lock. You have to give receipt and everything. So there is no risk of revenue. Simple. You just need an approval of proper officer. cleared for home consumption, we know. If you want to clear the goods for home consumption, you need to present ex bond bill of entry. You need to pay all the duties plus applicable interest penalty. If PO is satisfied, he'll permit you to remove your goods. You can also relinquish your title. We've studied this in importation exportation chapter. You relinquished goods, department will relinquish the duty. So owner may relinquish the title, then you are not required to pay any duties only. But since you've kept the goods in warehouse, penalties, if any applicable, you will have to pay. But if there are offensive goods, say for example, you've imported gun, kept in warehouse, now you are afraid of being caught and therefore you're relinquishing the title, that won't do. If any goods are offensive goods, you've imported bomb or certain things like that, in that case, no relinquishment will ever be available. Or if you are exporting the goods, importing goods, keeping in warehouse and exporting them as it is, then we know no import duty is payable. You just have to present your shipping bill and everything, which gives the evidence that you have actually exported. And if any export duties are required to be paid, that you need to pay. The exemption we are talking about is with respect to import duty. If government tells you to pay an export duty while exporting those goods, then that export duty will be payable. So export duty, fine, penalty, if any, assessed, have to be paid. Only import duty is waived. And PO satisfy himself that all regulations are compliant, he can allow you to directly export the goods without paying any import duty. Now, if Government of India is of the opinion that you are going to smuggle back the goods, so we think that these goods shall not be allowed to be exported without payment of duty, or there are certain conditions, restrictions which government want to put, they can put. So Government of India is of opinion that the goods are likely to be smuggled back. Just because you want to save your import duty, you are telling government that you are actually exporting, but you are essentially going to smuggle back those goods into India. You just wanted to save your import duty, or you are thinking of anything like that. In that case, government can direct you, no. First of all, you pay all the duties and then only we'll allow you to do anything. So such goods shall not be exported without payment of duty, and export can also be subject to certain conditions, restrictions which government wants to put. Allowance in respect of volatile goods. So neither the importer nor the warehouse keeper can be asked to bear the duty burden of normal loss. Now say for example, I have imported fuel, acetone, motor spirit, wine, beer, kerosene, which naturally evaporates. We cannot do anything. You cannot say I had put this liters of beer in the warehouse, but now I have less quantity, because it is very much natural that it is going to evaporate. So neither the importer nor the government nor the custodian, no one can be held liable with respect to duties for that particular normal loss which is going to happen for the volatile goods. Improper removal of goods. Now department says that only and only when proper officer gives you permission, you can remove your goods. Otherwise, your goods will be considered to be inappropriately removed. So section 71 prohibits removal except on clearance for home consumption, export or transfer to another warehouse. Whatever we have permitted you, either you can export, put into another warehouse, relinquish title, or you can clear for home consumption, only that you can do. If you do any other thing, we will assume that you have improperly removed, means it is prohibited only. Still, if you do, we will be considering it as a deemed inappropriate removal. Duty, interest, fine, penalty, everything will be applicable on you. So warehouse goods removed in contravention of section 71, not removed at expiration or not duly accounted for. In that case, duty, interest, fine, penalty, everything will be applicable. Cancellation and return of warehousing bond. So when the goods are cleared, exported or transferred, whatever is required to be done, you have done. Then whatever bond or security you had furnished, now government will free that. So PO shall cancel the bond as discharged in full. Custody and removal of warehouse goods. So till the goods remain in the warehouse, they are in the custody of custodian. So warehouse keeper appointed by licensee will be in charge of warehouse and shall have a computerized accounting system. All accounts records are required to be maintained by the custodian for a minimum period of 5 years. So whenever the goods are removed from the warehouse, important for MCQ. 5 years from when the goods are deposited into warehouse? No. The date on which the goods are removed from the warehouse. From that date, the accounts records with respect to those particular goods are required to be maintained for a period of 5 years. Also, digital copies, if needed, have to be preserved and produced. Warehouse keeper shall be the custodian of the warehouse goods. Say yes or no. Understood, everyone? Done clear with the entire chapter of warehousing. There is one question that I want you all to do. Other than that, if, this scrap question I've covered in the notes only, and the other questions are theory. There's one question that I want you all to do with me. So come to question bank of warehousing. Quickly, everyone. So warehousing, duty drawback. Okay, so here we have warehousing. See, this question is extremely simple. I'll just give you an overview. In this question, they are saying that this illustration also I've covered in the notes only. This ex importer, no duty, no interest. Then these are just, you need to say valid or invalid, which is okay. Enumerate. Okay, come to this question number 5. Good question it is. So Vipul imported certain goods in May. An into bond bill of entry was presented on 14th May and goods were cleared from the port for warehousing. So first of all, we know that the rate of exchange will be the date of into bond bill of entry. What is the date of into bond bill of entry? 14th May. Therefore, 65.2 is my relevant rate of exchange. Now, assessable value on that date was $1 lakh. The order permitting the deposit was for 4 months, issued on 21st May. So on 21st May, department allowed me to deposit my goods into warehouse for what period? For 4 months. Okay. Vipul deposited the goods in warehouse on the same day, but did not clear the goods. So I did not clear my goods even after my 4 months were over, from May to June, July, August, September. So for my 4 months were over on 21st September. But I did not clear the goods on 21st September. A notice was issued to me demanding duty and interest. I ultimately cleared my goods on 14th October. Okay. Compute the duty and interest. So now first of all we know that in case we do not clear the goods within the permitted time, when the permitted time gets over, we will deemed assume that the goods are removed. So the permitted time was over on 21st September. 4 months were gone. So I will deem assume that whatever is the customs duty on 21st September, that is required to be paid by us. Because the duty on the date of X bond bill of entry is what we take. So here we will deem assume that the goods are removed on 21st September and 10% basic custom duty will be fixed. Now talking about interest. So we know whatever is the period for which PO allows you to keep your goods in warehouse is fine. But interest will start as soon as 90 days expire. From the date of permitting you to deposit the goods. So if I calculate 90 days from 21st May is it? Sorry. Into one bill of entry was present on 14th May, the goods are cleared. Okay, right. 21st May. So now here, if I calculate 90 days, so the the period of 90 days commencing from the date of order made under section 60 expires on 19th August. How? So May has 31 days minus 21. May plus June plus July and August. So it comes to 19 August. How? See, May has total of 31 days, right? So 31 minus 21. 31 minus 21, I will take 10 days of May, plus 30 days of June, plus 31 days of July, and plus, I would say, May, June, July, and minus, if I do 90, it comes to 19 August. So this is where my 90 days expire on 19 August. My 90 days expire on 19 August. How does my 90 days expire on 19 August? May has a total of 31 days, therefore 10 days of May, 30 of June, 31 of July and 19 of August. Therefore 90 days expire on my 19th August. But ultimately, I have paid the taxes. On 14th October because they are saying that the period was over on 21st September, but I paid taxes on 14th October. Therefore, from expiry of 90 days till I make actual payment, I am required to pay 15% interest for warehousing. So here I would say 12 days of August plus 30 days of September plus 14 days of October. So for 56 days, I will be required to pay 56 upon 365 into 15% interest. The question is interest on what amount? Interest on what amount? Let's see. So the assessable value here is 1 lakh rupees. 1 lakh into relevant rate of exchange is 65.2. So 1 lakh into 65.2, which is 62 lakh or 65 lakh 20,000 assessable value, into 10% basic customs duty, right? Into 10% basic customs duty plus 10% of this as social welfare surcharge plus 10% I do. So my customs duty payable is 717,200. So on 717,200, I am required to pay 15% interest for 56 days. Is this question clear to all of us? Say yes or no. So this is an A category question which covers all the provisions of warehousing. Other than this, everything is theory which you can easily understand. So simply they are saying maximum period for which you can keep your goods in warehouse is 1 year. But if officer tells you some other period, like in this question officer has said 4 months, then the valid period would be 4 months. As soon as the 4 months expire, if I have not actually cleared my goods, we will assume that they are deemed removed. And whatever is this rate of duty applicable when my time is over, this will become applicable. My into bond bill of entry will always be relevant to determine the rate of exchange. Now order permitting can be any time. From into bond bill of entry, my 90 days will not start. 90 days will start as soon as proper officer gives me permission to deposit my goods. Officer gave me permission on 21st May. 90 days from 21st May. 90 days from 21st May expire on 19th August. Therefore, I know from 19th August, I have to start calculating my 15% interest till what date? Till the date I make my actual payment. And this is how I calculate my duty and this is how I calculate my interest. Quickly tell me yes or no. Understood the questions as well as the theory provisions of warehousing under customs. Everyone. Yes, ma'am. Then let's move to the last chapter for today, which is duty drawback. Again, extremely simple and a small chapter. If your exams are in May 2024, then you can just leave the video because duty drawback is not applicable for May 24 exams. Only for November 23 exams, duty drawback is applicable. For new scheme, government has removed duty drawback. Done. Everyone with me, dil dil agag bomb bomb, just half an hour more and we are done for today. Everyone, chalo. Yes, ma'am. So let's start with duty drawback. What is the meaning of duty drawback? Whatever import duty I have paid, I want drawback of the same. Simple. So drawbacks are of two types. One under section 74 and one under section 75. 74 is very much simple. Whenever goods are re-exported as it is, and the article is easily identifiable. I imported this bottle, I am exporting this bottle back. I imported calculator, I am exporting my calculator back. This is section 74. But I imported plastic, rubber, cell, manufactured a calculator and now exporting calculator. So two things is possible. One which says whatever I have imported, I am re-exporting that same particular thing. Another is saying I imported some materials, used them in manufacturing or process and now ultimately the manufactured goods are exported. So duty drawback is available in both of the cases. Let's see one by one. Section 74 says that duty drawback is allowable on re-export of duty paid goods if they are exported as it is. Now, first of all, when I am exporting the goods without any use, means I am not using the goods at all. I imported a new bottle, kept it and now I am re-exporting. Means I am not using the bottle. Now I can export normally also, as baggage also or as post also, which is fine. The ultimate idea is only I am exporting the same goods that I imported without any use. So whatever import duties I had paid, 98% of that I will receive as duty drawback. So 98% of my duty paid while importing those goods will be available to me as drawback. The conditions to be satisfied are extremely simple, that the goods has to be identified as the goods which were imported and the goods have to be entered for export within 2 years. So whenever I paid the taxes, whenever I paid the import duty, see, the date of importation is not relevant. The date on which you paid the duty, the date on which you paid the duty, from that date within 2 years, if you re-export these goods, then whatever import duties you had paid, 98% of that you will get as duty drawback. The only condition is within 2 years from payment of duty, and those goods has to be identified by officer that yes, this was the bottle that I imported and this is the bottle that I am re-exporting. Right. Now again I am exporting the goods as such only, but after use. Means I imported this bottle, I used this bottle for a certain time, I have not used it to manufacture anything else. Bottle only imported, bottle only being exported, but after using this bottle, then what to do? So your government is saying for these articles, for wearing apparel, tea chest, exposed cinematographical films by censor board, unexposed photographic films, paper plates, x-ray films. For these things, if I use them, even for 1 day, no duty drawback will be available. If without exporting as such I export, then 98% duty drawback is available. But for these things, if I use them, then no duty drawback will be available. If exported as such without use, then 98% provision still applies. But if I happen to use them, then no duty drawback will be available. Right. For other things, whatever I am using, my duty drawback will get reduced. So say for example, up to 3 months I use. So not more than 3 months if I am using these imported things, then 95%. Now not 98%, but 95% drawback will be available. More than 3 months up to 6 months, 85%. More than 6 months up to 9 months, 75%. So 3 months you have to keep adding, then 9 to 12, 12 to 15, 15 to 18, more than 18, nil drawback. So you just have to add, keep adding 3 months, and your drawback will keep reducing. So 95 to 85, 75. And then 70, 65, 60 and nil. So if you use your goods, so for every month, now part of month will be considered full month. So for every month you are using these articles, you will have to calculate your drawback accordingly. Even if imported goods are merely tested, you cannot say I just tested them, I did not use them. They will be considered used only and your drawback will fall to these new percentages. This is for all the goods except motor vehicle and personal goods. See, understand. If I import anything, I do not use it, re-export as it is within 2 years, 98% drawback available. If I use them, then there can be 3 cases. If I am using these wearing apparel, tea chest, etc., no drawback available. If I am using motor vehicle or personal and private use goods, then I will apply this. Other than that, any other goods I import, use and re-export, then these reduced percentages of drawback will become applicable. So what to do for personal and private use? See, again, without using you re-export, 98% drawback available. If you use for every quarter and part of quarter, and quarter under customs are not fixed like GST. GST, Jan, Feb, March, April, May, June, quarter are fixed. Customs, date-wise 3 months quarter you have to calculate. So here for first year, every quarter 4% reduction. Second year, every quarter 3% reduction. Third year, every quarter 2.5% reduction. So whatever import duties you paid, say for example, I paid 5,000 as import duty and I am re-exporting the goods, re-exporting personal, private or motor vehicle after using them for let's say 2 quarters. Then from this 5,000, I will have to reduce 4% for 2 quarters and calculate my drawback amount. Understood? So no duty drawback after 4 years. Maximum using them for 4 years, you can re-export. After that, no duty drawback available. And for cars, it is 2 years only. For car, it is 2 years only. Like CBIC can permit for more than 2, less than 4. But in a specific case where you request them. Normally for personal private products, it is 4 years. For car, it is 2 years. But car can extend till 4 years also if you can go and seek permission from CBIC. Done. Now re-export of imported goods. Now you can either export them by post or post this, we have actually covered in the chapter of post and stores, but still I will repeat it again here. So whenever you export certain goods by post and you want to claim drawback on the same, you will have to mention on the outer packaging that outer packaging shall carry the words that these are drawback exports. Plus, you will have to deliver to the component postal authority a claim in prescribed form. So to the postal authority, you will give a claim that I want a duty drawback with respect to these particular exports. The date on which this claim is received by customs officer. So the postal officer will transfer this claim to the customs officer. So the date when which postal officer transfers your claim to customs officer received these claims, will be considered as your date of filing duty drawback claim. So whenever the date on which aforesaid claim received by proper officer of customs from postal authorities shall be the date of filing duty drawback claim. If there is any deficiency in the claim, they will give you a deficiency memo within 15 days. You have to make compliances within next 30 days. Then final acknowledgement will be issued. So when there is a deficiency, in this case, after you rectify the deficiency, the final acknowledgement will be treated as your date of filing claim. Otherwise than that, normal cases, whenever officer transfers to the proper officer, postal officer transfers to the customs proper officer, will be considered as your date of filing claim. But if any deficiency, memo within 15 days, you get 30 days to rectify. After you rectify, a final acknowledgement is issued. Now this acknowledgement will be date of filing claim. Manner and time of claiming duty drawback other than post. So post we understood. Now other than post. Other than post is again extremely simple. Within 3 months. So whenever, within 3 months from the date on which clearance of loading of goods is passed. So once you import the goods, then you re-export the goods. Today I re-export my goods. For what period? Within what period from exportation I have to run to claim my duty drawback? They are saying 3 months. So I import certain goods. For re-exportation, I know 2 years if I'm not using. If I'm using, then other cases are possible. In that cases, I can just re-export my goods back. After re-exporting, within 3 months from the clearance order for loading the goods. So within 3 months from when you export your goods, you have to run and file a claim for duty drawback. This 3 months can be extended by further 3 months also, and then further 6 months also. But in this case, you will be required to pay a fees. So if I want a one-time extension of 3 months, I will pay 1% of FOB of export or 1000 rupees, whichever is less. I want to extend it for more 6 months. Then 2% of FOB or 2000, whichever is less, I will be required to pay as a fees in order to get extension of time period to file my duty drawback. Date of filing claim, whenever the officer gives me a stamp of fixing that yes, we have received your claim, that will be my date of filing claim. Again, if any deficiency is found here, same thing like post. 15 days, they'll give you memo, 30 days you make compliance, and whenever you make compliance, everything is okay, that will be your final date of filing claim. Understood. So this was all about section 74. So half chapter done. Very much simple. Under section 74, you import certain goods. Now you can either export them as it is without using, or you can use them. If you export as it is without using, 98% duty drawback you receive, but the condition is you need to re-export within 2 years from the date of payment of import duty. If you use those goods, 3 cases possible. For wearing apparel, tea, chest, x-ray, etc., no drawback available if you use them. For motor vehicle, personal use, we have reduction available with us. For other than motor vehicle, we have that 95%, 85%, 75% table that is available with us, and that you are required to learn by heart. Understood. Now talking about section 75, which is extremely simple, saying that I import certain goods, I use them in a manufacturing process. I manufacture certain goods out of it. Now I export my manufactured goods. Now how I will be allowed duty drawback? So drawback on imported material used in the manufacture of export goods. When the imported goods are used in manufacturing and the manufactured product is exported as normal export or post. Now here baggage is not allowed. Only normal export or post. Drawback is available as per the rate per unit fixed by government. There is no time limit to export. See, understand. Manufacturing can take a lot of time. Today, I import bottle, I re-export bottle. There's no problem. I import raw material. We do not know how much time it takes to manufacture certain things. So here time limit is not there. But value addition criteria government can put. Also, there has to be some forex realization also as per FEMA. When you send your goods from domestic tariff area to SEZ unit, then forex realization is not applicable. Other than that, your goods are being exported out of India, forex realization will be applicable. No drawback if export value is less than import value. Obviously, if I import certain raw materials at a particular value, I have done entire manufacturing process on that raw material. Now I'm exporting those goods. I cannot keep my export value less than my import value. Understand? For whatever I've exported, I will receive foreign currency. For whatever I've imported, I have to pay foreign currency. Government will have a deficit, a negative balance in this case when your export value is less than import value. Why? Because you will be paying more, receiving less. Why will government be willing to give you benefits in case when you are losing our forex reserves? So obviously, if your export value is less than import value, no duty drawback will be available to you. Also, material used in the manufacturing goods or export value does not exceed a certain percentage. Government can also fix some percentage that if you have imported raw materials worth 100, at least your export value should be 120. So government can keep like a 20% value addition criteria, 10%, 40% criteria, whatever government thinks fit. It can put that criteria that if your import price is this, at least there has to be this value addition. Then only we will give you drawback. No duty drawback if goods manufactured out of duty-free imports. Obviously, if on imports you have not paid any duty only, then what drawback we will be giving you? So if the imported goods had no duty being levied on them, obviously no question of duty drawback arises. How the drawback is given? It is all industry rate, means average amount fixed. Now government fixes an amount that normally for these products, whatever is the export value, certain percentage government fixes. Maybe 20%, 30%, 40%, 70%, 80%, whatever government wants to fix. So a certain percentage is fixed by government for drawback, which is known as all industry rate. If the product that you are supplying has no all India rate for it, then within 3 months from let export order, you can go and apply for a brand rate. So if all India rate is not available, all industry, no, all India rank, no, all industry rate. If all industry rate is not available, in that case, you can apply for a special brand rate within 3 months from let export order. Again, these 3 months can be extended. Same fees and same period that we studied in section 74. This 3 months can be extended. Also, if there is an all industry rate, but it is less than 80% of what actual import duties you have paid. So whatever import duty you have paid as per all industry rate, you are getting less than 80% drawback of the same. Then within 3 months of let export order, you can apply for a special brand rate. You can apply to government that, see, we know there is an all industry rate, but it is actually less than 80% of what taxes we have paid. We should be getting more drawback. Then you can go, even if there is all industry rate, you can go and apply for a special brand rate. If there is no industry rate, in that case, you are anyways going to apply for a brand rate. But once you have filed your claim under all industry rate, after that you cannot go to apply for brand rate. You have to think that earlier only. Understood. Provisional drawback can be given till the fixation of brand rate and everything is going on. Later, whatever is shortfall excess can be adjusted. Extension can be done. Right. Maximum drawback. Whatever is your exported value of product, whatever is the market price of your export product, 1/3 can be given as drawback. See, understand. Today, if I import certain goods worth 100, what will be duty on the same? 10%, 20%, 30%. So maximum duty would be like 30 or 40 rupees, something like that. I export it. Means I make some value addition. I export these goods for, let's say, 150. What maximum drawback I can give? Drawback is not of the value. Drawback is of the taxes or duties that I pay. What can be the maximum duties? They can be 1/3 of the export amount. So they are saying whatever is your export value, maximum 1/3 of your export value, we can give you as your duty drawback. Because duty drawback is of duty, not of the total value. They are not saying 1/3 of the duty we will give you. They are saying of the total export value, 1/3 drawback we can give, which is very much practical also. Interest extremely simple. Whenever you submit your claim for drawback within 1 month, you should receive duty drawback. If you are not receiving duty drawback within 1 month, then they will give you 6% per annum interest after expiry of 1 month. This we all know that when the 1 month expires, your interest is going to start till the date when you actually receive the drawback. In case they had given you erroneous drawback and they have to take it back, So the day when they give you erroneous drawback, from that till you actually refund it to them, 15% interest will be applicable. So if drawback paid erroneously or becomes recoverable, interest 15% from date of payment till the date of recovery of drawback. You have to pay it within 2 months. See, whenever department demands, you have to pay it within 2 months. If you do not pay within 2 months, other penal consequences can arise. So it is not that interest will start after 2 months. Interest will start right from the date when I received this wrong drawback till I give back this wrong drawback to the government. Interest will start. But they are saying within 2 months from order I have to pay this. If I do not pay within 2 months, then interest so anyways I have to pay. Certain other prosecutions penalties can also start on me. Prohibition simple. Do not do chindi bana. What is chindi bana? I don't know. So if your drawback is less than 50 rupees, do not apply only. Market price of the goods obviously has to be more than drawback. If your market price is less than the drawback, do not apply for drawback only. And if government thinks that you are going to smuggle back those goods, government can also reject your drawback claim. Extremely simple chapter this was. This 15% is important. Sometimes comes in questions where they will tell you that the drawback was given to you erroneously on, let's say, 10 Jan 2023. Government gave you an order to give back that drawback on, let's say, 20 Jan 2023. You gave back on 30 Jan 2023. Means you have given within 2 months only. Still interest will be applicable. You got this wrong drawback on 10 January. You refunded this amount on 30 January. So for these 20 days, 15% per annum interest you will have to pay on whatever is the duty drawback amount. This is it. Done. If your exam is in November 24, this chapter is, May 24 onwards, chapter is not relevant for you. November 23 people, the chapter is relevant for you. So here we complete valuation, warehousing and duty drawback. Hope you enjoyed this session. The target was to complete somewhere in 3.5 to 4 hours, but we've taken, I guess, 1 hour extra. But I think the clarity that we've got today is phenomenal. All questions we have solved, understood what wrong we can do, what right we can do, and these 3 chapters collectively in November 23 examinations can give you greater than 10 marks, because 5 to 7 marks are of valuation only. Now, if a question comes from warehousing or duty drawback, which is extremely likely, it would be of more 5 marks. Or if all of 3 chapters come, then the weightage can range to 12 to 15 marks also. So make sure you practice everything nicely, revise everything nicely, and focus more on the question practice once you are done with the provisions. We will keep meeting for such YouTube sessions to solve questions, revise things. And also we have our full syllabus marathon. We have our full syllabus GST marathon on 30 August, where we are going to revise entire GST in English. If you understand Hindi, then you can join the GST marathon on 28th. 29, we have Hindi Customs Marathon. 30, English GST Marathon. 31, English Customs Marathon. Now, since we have completed these 3 chapters in this much depth today, again in English Customs Marathon, I will not be taking these topics, and the remaining topics will cover in marathon and just brush up through these topics. Yes, so I hope everything is clear. Take care, study well, and I always keep saying consistency is the key. So just keep going. If there is any issue, any query, 9714 is my number. I repeat, 9714 is my number. You can anytime telegram me or WhatsApp me. All the links, my Instagram, LinkedIn, Telegram, YouTube, everything, whatever you need is provided in the description of this particular video. If you like the video and this has actually benefited to you, do like the video, share it with your friends, and comment on the video so that YouTube recommends the video to other students also, and they can also avail the benefit of the same. Sure, we'll keep meeting.